Hello and welcome to Session 19 of the Basic Tax course. We're going to begin Session 19 with a review of the Session 18 quiz, and we will begin that quiz with question number 1. Which of the following cannot be reported using the installment method? Well, it happens to be, as you recall from the earlier lecture that we had on installment sales, that installment sales are used to report income that you receive over a period of more than 1 year from the sale of an asset in which you have a capital gain. And really, the only part of the gain that can be claimed over time is the capital gain. And recapture Section 1245 gain is reported on line 14 of the 1040 form. It is not reported on line 13. And so in essence, it is not a capital gain, and it's not eligible for the installment method. Therefore, when you sell a capital asset that has the recovery of depreciation in it, to the extent that you have gain from that recaptured depreciation, you are not allowed to use the installment method. And what kind of property is the kind of property that you have to recover or recapture depreciation on under ordinary income rules? Well, that kind of property is Section 1245 property, and that makes C the correct answer. Line 3, John and Betty Ford were married in September of 2012. They each decided to sell their own homes and purchased a new home together. Both John and Betty meet the ownership and residency tests for their respective homes. John sold his home at a gain of $325,000 and Betty sold her home at a gain of $150,000. What is the amount of gain that they can exclude from income on their joint return for the year? Well, although you are allowed to exclude up to $500,000 of gain on the sale of a home, that as a married couple, the $500,000 has to apply to a home which was owned and occupied by both of you for a minimum of 2 years. And it is possible that you can claim the exclusion even if only one of you owned the home, as long as both of you occupied the home for 2 out of the last 5 years. When we look at this problem, we can see that John occupied his home for 2 out of the last 5 years, but Betty did not. And conversely, Betty occupied her home for 2 out of the last 5 years, but John did not. And as a result, they're not going to be able to exclude full $500,000. John is going to be able to exclude the maximum amount of gain possible for his one home, $250,000. Betty will be allowed to exclude the actual amount of gain she had of $450,000, and that makes B, $400,000, the correct answer. Jerry purchased a rental home in 1996, and he moved into and lived in the home from April 15, 2007 through September 1, 2011. He then rented the home again until he sold it. Jerry has not claimed the sale of home exclusion in the last 2 years. Which of the following statements is true? Well, the way we work this particular problem is we need to look at any depreciation claimed after May 7, 1997. And there is a rule that says if your home was used for rental purposes, any depreciation claimed after 2008 due to a period of rental after or that comes before you live in it has to be recovered or recaptured. But in this case, all of the rental use comes after Jerry moved out, and there is no non-qualified use after 2008 that comes before the date that Jerry lived in the home. So Jerry lived in the home after 2008, but he did not occupy the home and then he didn't occupy the home by renting it and then move into it after he finished renting it in a time frame that falls after 2008. So it's a really convoluted rule. But you essentially look at 2008 and say, after 2008, was there any rental use? And the answer is yes. The next question we have is, was that rental use preceding or following a period of personal use? And the answer is, it followed a period of personal use. And because it followed rather than preceded a period of personal use after 2008, the gain can be excluded as long as Jerry meets the ownership and occupancy tests for the 5-year period before he sold the home. So 2 out of 5 years he lived in the property, he meets that test. But because he sold the home and the home was eligible for depreciation, he will need to recapture any depreciation he claimed after May 7, 1997. The next problem we have in line is the mini problem, and this mini problem involves a character named Dora Explorer. She sold her vacation home to SpongeBob, and she has the following information to report for the sale. Firstly, she bought the home on January 31 for $2,011 at a cost of $200,000, and then she sold the home on May 31, 2012 for $400,000. She also made some improvements to the property, and you can see that there was a new roof, new landscaping, remodeling. And when we add these improvements up, we get total cost of improvements of $18,000. And you can see that there were some repairs that went on, but repairs do not add to cost basis in the property. So when we're looking to figure cost basis for Dora Explorer in her home, we need to look only at what she paid for the home and then add to that the cost of improvements. $200,000 plus $18,000 is $218,000, and we're going to enter that cost basis here on line 8 of the 6252. Then we move over to the next concept, which is expenses related to the sale. And as you can see, line 11 of Form 6252 asks for expenses relating to the sale, and we've provided you with those numbers: required repairs, commissions, closing costs. When we add those numbers up, we get $30,000, and so we're going to enter $30,000 on line 11. Next, we have payments that were received during the year. And payments that were received during the year are going to figure into the taxable gain for the year, and so we need to add those up. There's a down payment of $50,000 and principal payments that were made during the year of $2,500. We add those two numbers together, and we enter them down here on line 21, $52,500. And then finally, the problem tells you that interest paid during the year by the buyer was $8,000. That doesn't go anywhere on the 6252 form. Instead, it carries to Schedule B, and it is entered as ordinary interest income on line 8A of the 1040 form. But finishing off Dora Explorer is 6252. Obviously, we've entered a description of the property, the date acquired, the date sold. It was not resold to a related party. The sales price is $400,000. You can see right here we tell you it's $400,000. So that $400,000 sales price does carry to line 4. There's no assumed mortgage, and we move on to line 7 and carry lines 5 to line 7. We then subtract out the cost basis. We add in the expenses of the sale, and when we're done, we have a cost basis of $248,000. We subtract that from the selling price of $400,000 to arrive at the gain of $152,000. The next step is to divide $152,000 by $400,000. And when we do that, we get 38%. So that becomes the gross profit percentage. 38% of $52,500 gives us $19,950. Moving on to the Schedule B, we can see here on Schedule B, we've entered the amount of interest that was paid by SpongeBob, $8,000. So that concludes the review of Dora Explorer 6252 and her Schedule B. Now let's move on with the Session 19 lecture. We are going to get going now with the topic of today. So welcome to Pacific Northwest Tax Service's presentation of rental income and passive activity limits. Lots to discuss in today's class, as is always the case with me. And hopefully you'll walk away from today's class with a really good, thorough understanding of how to report rental income and expenses, and also how the losses that you have with passive activities such as rental property may be limited because of passive activity loss limits, but also because of the at-risk limits. So again, we're going to be covering all of those topics. As usual, I have a reading assignment, and most of the content of today's class comes from the publications listed in the reading assignment. We have IRS Publication 17. There's several pages in there we recommend you read. We also have IRS Publication 527, which is on residential rental property. That particular publication is specific to residential rental property, and of course it is possible to have rental income from sources other than residential rental property. But many of the rules described for residential rental property will repeat themselves with commercial rental property, but there are some key differences in terms of depreciation and how depreciation is treated with those. Then we have Publication 925, which discusses passive activity and at-risk rules. There's also Form 8582, Passive Activity Loss Limitations and the instructions for that form, and then the instructions for Form 6198, At-Risk Limitations. Moving on to the first page, following that cover page, technically page 2, we are now looking at Schedule E, page 1. And Schedule E, page 1 was quite dramatically changed for tax year 2011, and for 2012 it retains the same look that it had in 11. IRS incorporated numerous changes to help with, I would assume, enforcement of regulations surrounding the types of income that need to be reported on Schedule E, and also the reporting requirements of people who have rental property, make sure that they're completing the form correctly. The changes that they made are largely, based on what I'm seeing, designed to help ensure people are filling the form out correctly and not claiming expenses in a way that they should not. Of course, it's likely the case they're still doing it wrong, because so many people do get tax forms like this wrong, but I do see the effort as being one that would improve things. So let's just take a look at the front page of the 1040 here. You can see that we have Part 1. There is space provided for a series of questions, and the very first question in line is, did you make any payments during the year that would require issuance of a 1099 miscellaneous? It then provides space for an address. It provides space to list the type of property that is being rented. It provides space for the use of the property, either rental use or personal days of use. It also provides space to enter income from either rents or royalties, and then we move on to expenses. So page 1 of Schedule E is devoted to reporting rental income and expenses, as well as royalty income and expenses. But there is a page 2 to Schedule E, and we're going to be taking a look at that page as well. Not line by line the way we do with the front page of the 1040, but we're still going to be looking at some key elements of how page 2 works with the tax return, specifically in terms of how passive activity income and loss is allowed to flow through to the 1040. And let's take a look now at the Schedule E definitions themselves. Schedule E is used to report income or loss from rental real estate, as well as royalties, and from partnerships, S corporations, estates, and trusts. And of course, in the case of partnerships, S corporations, estates, and trusts, we're really referring to the K1 income that flows through from those entities to the individual owner or shareholder or beneficiary, depending on the nature of the relationship, to the 1040 of that individual. You should not use Schedule E to report income from the rental of personal property, real estate activities if significant services are provided, or royalty income you receive as a self-employed writer, inventor, or artist, or anything remotely like that. Firstly, we're going to look at rental income and defining when you have received rental income. Rental income is any payment you receive for the use or occupation of property that you own. All of the following forms of payment are considered to be rental income and must be reported. They include things like money, cash, check, credit card payments. Basically, any method of collecting money is going to be considered to be a form of payment. Also, advance rent, payment for canceling a lease, expenses paid by a tenant for a landlord are considered to be income for the landlord, and also property or services that a landlord receives in exchange for rent. All of that is considered by the IRS to be a form of rent. So let's take a little bit of a look at some of these as examples. Example number 1. You agree to forego rent valued at $1,000 for 1 month if your tenant agrees to paint the house that he rents from you. You will need to include the $1,000 as rental income for that month. So your tenant didn't pay you $1,000, the tenant paid the house instead, and the fact that the tenant provided a service to you means that you're going to have to treat that free service as income. And essentially what's happened is barter, and the IRS says that when you have an exchange of services for property, that you do have barter going on, and barter does need to be reported. Now, in the case of the rental property, if that paint job was a repair, then you would be able to deduct the cost of the paint job as a rental expense. So in effect, they would balance each other out, but the IRS still wants to see the rental income reported, and then you would claim the repair as an expense. Example number 2, you agree to trade rent for your tenant's car. You must include the fair market value of the car as rental income in the year that you receive it. And example number 3, your tenant pays the water and sewage bill for your rental property and then deducts it from the normal rent payment. Under the terms of the rental agreement, you and not your tenant are responsible for paying this bill. You must include the amount paid by your tenant in your income, but you can then deduct the cost of the utility as a rental expense. Security deposits. Now, it's not uncommon when you take out a lease to have to pay a security deposit. And any intelligent landlord concerned about the welfare of the property that they're renting out is going to be asking for a rental deposit if they can possibly get one. So security deposits are not typically rental income if you plan to return the deposit to the party who is renting the property. However, if you later decide to keep the deposit because the tenant does not live up to the terms of your rental agreement, then you must include the deposit in your income for the year that that deposit is forfeited. So let's just suppose you have a rental property, and as a condition of renting that property, you ask for first month rent, you ask for last month rent up front. And then in addition to that, you ask for a security deposit of $1,000. The security deposit is refundable provided the tenant completes the terms of the lease and leaves the property in good condition. Now let's just suppose that the tenant arrived to the end of the lease period and they move out, and you go through and do an inspection of the property and you find that they've done damage to the property. So you look at an evaluation and you determine that the damage to the property is $500, and so you retain $500 and refund only $500 of the $1,000. Well, at the time you make a decision to keep that $500 and make it non-returnable to that tenant, at that point in time it would become income to you and would be reported as income. Rental expenses. This is where we're going to be spending the majority of the first part of today's class, is talking about the individual expense items that you can claim on Schedule E, how you go about claiming them, how you go about prorating them if necessary, and whether they're allowed at all. You generally deduct rental expenses in the year that you pay them, and you can deduct expenses you incur to operate and maintain your rental property. You can also deduct any expenses you incur while your property is for sale. This is one of the interesting things I regularly run across in preparing tax returns for clients, is that they may have had a rental property for a number of years, and now that they have decided to sell it, they've essentially canceled any leases that they have, or they've not renewed them, so that they can get the tenants out of there, get the property cleaned up, and get it for sale. Sometimes it's the case that the property is still being rented and it's being held for sale. It could be a number of those things, and it may be that the tenant moved out without being asked to move out, and then the property has remained vacant. The landlord has been looking for tenants and finally decides to sell it. But what the IRS says is that even though the property is not occupied, if its purpose is to be a rental property and it's held as a rental property, and that function has not changed, the fact that it's on the market does not mean it's no longer a rental property. And so the IRS wants you to continue deducting expenses even for the period of time that it is up for sale. So in the year that a decision is made to sell a rental property, it doesn't stop being a rental property. It's still a rental property, and you would continue to report and claim expenses for that property through the date of the sale, even if you have no rental income coming in from it. Repairs and maintenance, amounts you spend to keep your property in good operating condition or to repair damage to the property, are allowable expenses that you can claim. But be aware that improvements are not deductible expenses, and you need to pay attention to the nature of an expense that has been incurred with regards to a property and establish whether that expense meets the category of a repair or maintenance item or whether it is really an improvement. Because if it is an improvement, improvements are not deductible. An improvement adds to the value of your property or prolongs its useful life or adapts it to new uses. You must capitalize the cost of improvements you make to your property. You can generally depreciate improvements you make to your rental property, but you should treat each improvement as a separate piece of property for depreciation purposes. Now, I do want to point out, though, that there is an exception to that rule. Let's take a look at the acquisition of a rental property in the first place. There is a day where you acquire the property. You either acquire it because you purchased it as a rental property, or perhaps you have your existing home that you decide to convert to rental property, or perhaps you even inherited a rental property or a property that you decide to rent out. On the day that you decide to rent your property, you're not going to be breaking down that rental property into all of its component parts. You're essentially going to have the house as a whole, that property as a whole, and you're going to need to determine what your basis in that property is, and you start to depreciate that property as a whole. But subsequent to that, if you make improvements to that property after you started renting it, then those individual improvements have to have their own line on the depreciation schedule. So when IRS says track each improvement separately, they're not talking about every little piece of the house being broken down into component parts and listed on the depreciation schedule. They're basically saying when you first place it for rent, you're going to have one line item for the house, you're going to have another item for land value typically, and then after that, any additional improvements will get their own line items on the depreciation schedule. But let's take a look at examples of the types of improvements that can be made to a property, and these come from IRS Publication 527. Examples of improvements include things like additions, such as a bedroom, bathroom, deck, garage, porch, or patio. Also, the lawn and grounds. It's possible to do improvements to the lawn and grounds by doing landscaping, putting in a driveway, putting in a walkway or a fence, retaining walls, sprinkler systems, and even swimming pools. Examples of other miscellaneous types of improvements include storm windows and doors, a new roof, a central vacuum system, wiring upgrades, a satellite dish, and a security system. For heating and air conditioning, there's the heating system itself, the central air conditioning, furnace, ductwork, central humidifier, and a filtration system that could be made as improvements to a property. With respect to plumbing, lots of improvements can happen around plumbing. You could put in a new septic system, you could put in a new water heater, you could put in a soft water system, or a filtration system, and all of those are considered to be improvements. For interior improvements, you could put in new appliances, you could modernize or update the kitchen, you could put in new flooring, you could put in new carpeting. And other types of improvements are energy efficiency types improvements, such as insulation in the attic walls, pipes, and ductwork. So any of those types of expenditures on a property are typically going to be considered improvements if they are improving the value or extending the life of the property. But it is possible that you would go into a property and rather than adding insulation and improving the property in some way, you're repairing a hole in the wall, there's some insulation that's damaged, and so you replace that insulation. And that would be a repair. So typically, you do want to be thinking about the nature of the work that's been done on a house and then making a decision about whether that is an improvement or a repair. If it's a repair, you deduct it, and if it's an improvement, you must capitalize it. Let's look at some other types of deductible expenses, common ones that we would normally run across. They include advertising, cleaning and maintenance services, utilities, fire and liability insurance, taxes, interest, commission for the collection of rent, if you're paying an agent to do that for you, and the ordinary and necessary travel and transportation expenses associated with managing the property. Now, with regards to advertising, in the 20 years I've been doing taxes, advertising has really faded away. I don't really run across too much expense for advertising anymore because most people advertise their properties for rent on Craigslist. It's no longer in the classified ads of the newspaper where you have to pay money. It's for free on Craigslist. So I don't typically run across too many clients that spend a lot on advertising anymore, but it's possible that you will see that. Now, another topic that comes up in Publication 527 that the IRS makes a big point about, and therefore I feel it's necessary to talk about it in today's class, is points. Points are, of course, something we should all be familiar with, and when you purchase a property or you refinance a property, it may be that you have to pay points to get the interest rate down. Perhaps you've been offered a 5% interest rate, but if you pay 2 points, you'll get it down to 4.5%, or you'll get it down to 3.5%, or whatever the going rate is, and however much you have to pay for points to make that happen. Points are often associated with the risk of the loan as well, and if you are higher risk, you might have to pay more in points than if you are lower risk. And of course, risk would be based on your income and your credit rating. But at any rate, if you are purchasing a property and you pay points, or if you are refinancing a property and you pay points, the IRS has a specific methodology that it wishes you to apply in determining how much of those points you may be able to deduct or amortize over time. So points paid when you take out a loan or a mortgage result in original issue discount, or OID. In general, the points, or OID, are deductible as interest unless they must be capitalized. You may deduct the points you pay on your mortgage if your total OID is de minimis. And I always joke about de minimis because it comes up in IRS tax law all the time. And I just think of de minimis as, well, the minimum or de minimum if you're being a little silly. It's the smallest amount at which the IRS is going to either disregard it or allow an acceptance of it. And sometimes de minimis means you don't even have to report it. For example, we're going to learn in a little bit that there is a de minimis concept around the use of rental property. And if you use rental property for fewer than 15 days personally, Or if you have people pay you rent for fewer than 15 days, those are de minimis items that don't need to be considered as far as the IRS is concerned. And when it comes to points, they have this de minimis concept again. The IRS says that if your points are de minimis, you do not deduct them in the year paid, you must amortize them. And it says you may deduct points you pay on your mortgage if your OID is de minimis, and if your points are de minimis, then you amortize them over the life of the loan. So what is de minimis OID? The OID is de minimis if it is less than 1/4 of 1%. In other words, 1/4% less than that, of the total stated redemption price at maturity of the loan multiplied by the number of full years from the due date of original issue to maturity. That's a fancy way of describing something, so let's just see what the IRS means by that. And here's an illustration to do that with. On January 1, 2012, you took out a loan for $100,000. The loan matures on January 1, 2022, which is a 10-year term. And the stated principal amount of the loan, $100,000, is payable on that date. An interest payment of $10,000 is payable to the bank on January 2 of each year, beginning on January 2 of 2013. So most loans, of course, don't work like this. This particular illustration is done just so we're not dealing with compounded interest or just making it as simple as possible. Now, when you took out this loan, you were required to pay $1,500 of points to the bank. The points reduced the issue price of the loan from $100,000 down to $98,500, resulting in $1,500 of OID. You determined that the points you paid are de minimis based on the following computation. You take the redemption price at maturity, which is the principal amount of the loan. You multiply that by the term of the loan in complete years, and then you multiply that by the de minimis amount of 1/4%. When you do that, you get $2,500. If the points you pay are less than $2,500, then they are de minimis, and that means that you are allowed to amortize them. And in this case, of course, they are de minimis because $1,500 of points paid is less than $2,500, the de minimis threshold. The points or OID you paid at $1,500 are less than the de minimis amount, and therefore you have de minimis OID, and you can choose one of 4 different ways to figure the amount that you can deduct each year. Firstly, on a constant yield basis over the term of the loan, on a straight line basis over the term of the loan, in proportion to the stated interest payments, or in full at maturity of the loan. And under the straight line method, you would be allowed to deduct $150 each year for 10 years. And do remember that when you're dealing with points and also with closing costs associated with the purchase of a property, anything that has to do with the loan itself to purchase a property does need to be separated out and not capitalized into the property, but kept as a separate line item on the depreciation schedule and amortized rather than depreciated. Let's take a look now at completing the Schedule E itself. We're going to look and break down this particular form into each individual line and spend some time talking about the lines and how you should treat those when you're preparing a tax return. We're going to begin with Part 1 of the form with lines A and B. For 2011 and later years, the IRS has added a new disclosure requirement to Schedule E. The disclosure requirement is directed at reducing the tax gap, and while the disclosure requirement on Schedule E is new, the law behind it is not. Thus, the disclosure requirement is a new tool that the IRS is using to enforce compliance of existing laws. So, one of the things that went on in 2011 is the IRS introduced these new checkboxes onto Schedule E, but it also introduced them onto many other forms as well. Schedule C, Schedule F, Form 1120S, Form 1065, other forms as well. And they're all basically putting onus on the business owner to be in compliance with the law. There were some efforts to change the law that were rescinded. In other words, they were so unfavorable that even though they became law, later on Congress changed its mind and took them away. And one of those was the requirement that rental property owners 1099 miscellaneous any contractors that work on their property, in the same way that a business might be required to issue 1099s. And so the law came into being, and it was going to be the case that businesses were going to have to 1099 everybody for pretty much everything. For example, if you were a small business owner and you went to Home Depot and you bought some supplies there and you spent over $600, the law was essentially saying you're going to have to 1099 Home Depot. And naturally, a lot of small business owners and a lot of people in the tax practitioner community got pretty upset about that onerous burden of having to report all of those amounts. And so that particular law was repealed, and it's no longer the case that rental property owners have to be 1099ing. So the question is, why do we see these questions on Schedule E as if people still did have to 1099? Well, what happened was the new law requiring 1099ing went away, but the old law requiring 1099ing didn't. And the thing is that there was already a requirement in the law for 1099ing as a requirement for businesses. And the requirement for businesses with regards to 1099ing is something we're going to cover in much more detail in the class later on Thursday in self-employment. I really get into who must 1099 and all the rules around 1099ing and the fines for failure to 1099. But the point being, if rental property owners were no longer required to 1099, how come the box is still on the form Schedule E? So I scratched my head on that issue and spent a lot of time reading about it, and here are my conclusions. My conclusions are that the instructions for 1099 specify who needs to issue 1099s. And in general, a business needs to 1099 if it pays more than $600 during the year to an unincorporated entity or to an attorney, whether they're incorporated or not. So the question is, what's a business? Is a rental property a business? Because if it is a business, then it needs to be issuing 1099s. And if it's not a business, it doesn't need to be issuing 1099s. And this is also coming from IRS. I actually got on the phone, talked to the tax practitioner hotline, specifically to people who are specializing in the 1099 department, and asking them, when does a rental property owner need to issue a 1099? Because IRS is obviously interpreting that a 1099 needs to be issued in certain cases by rental property owners, or they wouldn't put the check boxes on the form now, would they? So what is that determination? And IRS is saying the same thing that the rules are saying, that businesses have to 1099, and so when is a rental property a business? Well, the people at the IRS in the 1099 department said that a rental property is a business if there's a profit motive in operating it. Well, technically speaking, you shouldn't be reporting income and expenses on Schedule E unless there is a profit motive. But let's just suppose or think of a situation where perhaps there isn't a profit motive. And this is one that the IRS gave me over the phone. You might have an individual homeowner who is trying to sell their house. They can't sell it, and so they're forced to find a tenant to rent the home to basically make ends meet. Their intention is not to operate a business, but rather just to bring in enough revenue to keep their head above water, perhaps until a better point in time when the house becomes more marketable. And the IRS is saying that would be a situation where you don't need to 1099. But let's look at another situation where you might need to 1099 as a rental property owner. You own a rental house. You purchased it as a rental house. Your motive for purchasing that rental house is investment profit as well as revenue profit coming from the tenants. You're hoping to make money from the deal in the long run. Is that a business enterprise? IRS probably would say that it is. And from our perspective as tax practitioners, our job is to inform our clients of the law and also help them prepare for an audit, which may inevitably come to most people at some point in their lives. So let's get on with what the rules are saying about 1099ing, and bear in mind that although not everyone is required to 1099, as a tax practitioner I play more conservatively, and I recommend to my clients that they should 1099 if I think there's a possibility that they should 1099. And if they don't need to 1099, I'll tell them, but if I think that they probably should, then I'm definitely going to be on that because ethically I'm required to inform them of that requirement, and ethically I need to truthfully answer the questions that appear in these boxes. So question number A, did you make any payments in 2012 that would require you to issue or file Form 1099? Well, there's a question there, and as a tax practitioner, you need to answer the question. Is the client required to issue a 1099 or not? That means you as the practitioner, you need to know what the law is regarding requirements for issuing 1099s. So you have a competence issue there where you need to understand the law well enough, and you need to understand your client's situation well enough to establish whether the answer to this question is yes or no. Well, the first thing I look at is the client operating the rental property as a for-profit business type venture? If the answer to that question is yes, then the next thing I look at is, did they make any payments during the year to any single individual or unincorporated entity that exceeded $600? If the answer is yes, then they need to 1099, and I would check the yes box. Question number B, if yes, did you or will you file the required Forms 1099? Is my client going to file the required forms? Well, the only way I'm going to know that is if I ask them. And so I have to ask the question, and then I need to spend time explaining why they need to 1099. And here's the dilemma I'm running across. Most of the time, clients who own 1 or 2 small rental properties, they're not big business owners. They bought the properties sometimes after careful planning, sometimes on a whim. They've acquired this property. Now they're a landlord. And now they're dealing with, the landlord-tenant headaches and so forth. But the latest thing is now they've got me as a tax preparer telling them, hey, did you issue a 1099? Because during the year you paid a plumber $3,000 to come out and do some work on the house, and that plumber was an LLC, which means they weren't incorporated, which means you need to 1099 them, and have you done that? And if they say no, then they need to 1099. And now they're going to go back to the plumber and try and get the information necessary to issue a 1099, except maybe the plumber doesn't want to give them their Social Security number or their EIN after the fact. So it is a rather arduous problem. We'll get into much more detail in Thursday's class. We spend a lot of time talking about 1099ing, what's required, what to do when someone refuses to 1099. So I'm not going to do that here today. But just to get through today, I did want to focus on the issue that 1099ing is required of rental property owners. It's going to be your responsibility as a tax practitioner to establish whether a 1099 is required, and then you need to truthfully answer these questions. Income or loss from rental real estate activities. We're going to use Part 1 of the Schedule E to report income and expenses from rental real estate, including personal property that is leased with real estate, as well as royalty income and expenses. We're going to take a look now at line 1A and 1B. Line 1A is where you list the following information about each piece of rental real estate property. You show the street address, the city or town, and the state and zip code. On line 1B, down here, we're going to show the type of property and enter one of the codes under this section right here to indicate the type of property. So there's single-family residence, multifamily residence, vacation or short-term rental, commercial, land, royalty income, self-rental, and other. With regards to self-rental, enter code type 7 for self-rental if you rent property to a trade or business in which you materially participated. So let's just suppose you have a building that you own personally, and you rent that building to your business. That building that you rent to your business would be a form of self-rental, and you would need to put a code 7 for that. With regards to code number 8, if you can't think of how to identify the property, IRS says code 8 is used when none of the other descriptions seem to quite fit. Now this yellow section right here, this is where we enter the fair rental and personal use days, and this is a new section. It used to be a question, check this box if there was personal use that was greater than 14 days during the year. The IRS has done away with that personal use question, and now they're just saying, tell us the number of fair rental days, tell us the number of personal use days. And why is that? Well, you may not claim rental losses on property you used for personal purposes during the year if your personal use of the property was more than 14 days during the year, or 10% of the total days it was rented to others at a fair rental price. For each property listed on line 1A, enter the number of days in the year that the property was rented at a fair market value and the number of personal use days. And you'll see that we have column A, B, and C. That corresponds with property A, B, and C. And so if you have more than one rental property, you would need to separately track each of those properties, the number of fair rental days that it was rented at a fair market price, and the number of days you used that property for personal purposes. Let's move on here. Personal use of rental property. What is that? Well, the IRS says that a day of personal use is any day or part of the day that the unit was used by you for personal purposes, or any other person for personal purposes if that person owns part of the unit, unless the unit was rented to that person under a shared equity financing agreement. Anyone in your family or in the family of someone else who owns a part of the unit, unless the unit is rented at a fair rental price to that person as his or her main home. and anyone who pays less than a fair rental price for the unit, or anyone under an agreement that lets you use some other unit. So that is what the IRS defines as personal use. Now, use of rental property that is not personal use, IRS says when you count personal use days, do not include the following: any day you spent working substantially full-time repairing and maintaining the unit, even if family members used it for recreational purposes on that day, or any days you used the unit as your main home before or after renting it or offering it for rent, if you rented or tried to rent it for at least 12 consecutive months, or for a period of less than 12 consecutive months, at the end of which time you either sold or exchanged it. What happens when personal use exceeds 14 days or 10% of the days rented? If you use the property for personal purposes for 15 days or more during the year, you may not be able to deduct all of your rental expenses. Regardless of the number of days of personal use, however, you can still deduct all of the following expenses for the rental part of Schedule E. And that includes the mortgage interest, the real estate taxes, casualty losses, and any other rental expenses not related to your use of the unit as a home, such as advertising expenses and real estate agents' fees. So essentially, it is still possible to have a loss, a tax loss, on a rental property that you had personal use of, because it could be that the loss is being generated by the real estate taxes and the mortgage interest, as well as any other direct expenses you have relating to getting tenants in that unit. However, if you made personal use of the property for more than the allowed number of days, you can only deduct other expenses such as depreciation up to the amount of remaining income. So if you've got utilities on the property, you've got depreciation, you've got homeowners association dues, you've got insurance, those types of expenses are only going to be allowed to the extent you have income from the property, and if the property is running at a loss, those expenses are not allowed as deductions. If your other expenses exceed your income from the rental activity, the excess expenses cannot be deducted in the current year, and you will need to carry them over to the next year. Line 2 is QJV, stands for Qualified Joint Venture. If you and your spouse each materially participate as the only members of a jointly owned and operated real estate business, and you file a joint return for the tax year, you can make an election to be taxed as a qualified joint venture and report your business income on separate Schedule Cs with your Form 1040 return instead of filing a partnership or Form 1065 return. You should refer to the instructions for Schedule C for more information. Line 3 is rental income. This is where we're going to report how much money we brought in. You report gross rental income on this line if all of the following are true. You received rental income from real estate. You were not in the real estate business and holding the property for sale to customers. You did not provide significant services to the renter, such as maid service. Significant services do not include the furnishing of heat and light, cleaning of public areas, trash collection, or similar services. And I'm just now seeing I've got some questions on the board. Let's see what we've got. What if points are more than de minimis? Well, IRS is saying that if points are more than de minimis, they're not deductible. I've never run across that. Probably more information in Publication 527 that you could read on that, but I've never run across it. And then on an acquisition loan, can you deduct points in full in the year of purchase? The answer is no. Acquisition points paid on the purchase of property are deductible only when you're purchasing your home, or if you are refinancing a home and you're using extra money to make home improvements. Other than that, points are not deductible and they have to be amortized or capitalized until the property is sold. Those are the two options. So the following forms of income should be reported on line 3 of your Schedule E, and they include income received from renting a room or other space, fair market value of services or property you received instead of money for rent. Real estate professionals. If you are in the real estate sales business, use line 3 only to report rent received from real estate held for investment or speculation. Do not use Schedule E to report income and expenses from rentals of real estate held for sale to customers in the ordinary course of a real estate sales business. Instead, you should use Schedule C or CEZ for these rentals. So let's think a little bit about what that is saying. Let's suppose that you are in the real estate business, and part of your real estate business is acquiring properties, fixing them up, and then flipping them. Maybe you've even got a broker's license so that you can represent yourself when you're selling these properties and move them more efficiently, more economically. And when you have finished fixing up a property, you do get tenants in. The tenants live in that property while it's on the market, and then it sells. The IRS is saying if that is the nature of your business, that's not a rental business, that the income you receive from those tenants belongs on Schedule C, and of course that means it's subject to self-employment tax. It also means that it would not be subject to the passive activity loss limits, assuming you are actively participating in that business. But if you are still a real estate agent, say, and it happens to be the case that you purchase a rental property and the ownership of that property is passive in nature, that it would still go on Schedule E. So you really have to look at the nature of the type of activity, the purpose for the rental property, how that rental property is working with that real estate business. And if the property is considered to be a part of the business, then any income from tenants is self-employment income. If it is an investment property held only for collection of rent and appreciation over time, then it would still be a rental property reported on Schedule E. All right, rental income from farm production or crop shares. You report farm income and expenses on Form 4835, and you do so in the following situations. If you received rental income based on crops or livestock produced by the tenant, or you did not manage to operate the farm to any great extent, or you did not manage or operate the farm to any great extent, and you are an individual. So most of the time when we receive rental income, we report that rental income on Schedule E. And if you are a farmer who is paid cash rent for your land or other property so that another farmer can work the land, that too is reported on Schedule E. But there are certain situations, and apparently it's not all that uncommon, where a property owner who owns farmland will rent that land to a farmer, a tenant farmer, and that farmer will share proceeds from the crops or from the livestock sales. And if that's the case, then that type of income is reported on a different form, 4835, instead of Schedule E. And we'll talk more about 4835 at the end of today's class. Line 4 is used to report royalty income. If you received $10 or more in royalties during 2012, the payer should send you a Form 1099 miscellaneous or similar statement showing the amount of royalty income that you received. For royalty properties, line 2 and the address portion on line 1A should be left blank, and you should enter code 6 for royalty property. Now, there's different reasons why you would receive royalties. Let's just suppose that you're a musician. You wrote a musical piece, and you're receiving royalty income from that musical work that you created. Well, that would really be a form of self-employment income. It doesn't belong on Schedule E. Schedule E is when you have essentially, most commonly where I see it, is you might have purchased ownership in a publicly traded partnership that has royalty income coming in from the sale of, or the rights to sell oil on the land or coal on the land or whatever that particular PTP is invested in. And so you're receiving royalty income from that, and you're also being able to claim some of the expenses flowing through on that. And that is what the IRS is referring to as royalty income. They're not looking that you are receiving royalties because of a work that you created. Because if you're receiving income because of your own labor, that is a form of self-employment, even if it is called a royalty. And of course, the very next line here says royalty income from self-employment. If you are in the business as a self-employed writer, inventor, artist, etc., report your royalty income and expenses on Schedule C or CEZ. We're going to take a look now at lines 5 through 19 because this is where IRS says to report all of the expenses that you have with relation to your property. And we're going to take each of these lines in turn. And we're going to begin with just a brief introduction here. Enter your rental and royalty expenses for each property in the appropriate column, column A, B, or C. And if you have more than 3 properties, then you would attach supplementary additional pages of Schedule E. You can deduct all ordinary and necessary expenses such as taxes, interest, repairs, insurance, management fees, agent commissions, and depreciation. But do not deduct the value of your own labor or amounts paid for capital investments or improvements. Renting out a part of your home. As described later, beginning on page 22 of this manual, if you rent out only part of your home or other property, you deduct the part of your expenses that applies to the rented part. Credit or deduction for access expenditures. You may be able to take a tax credit for eligible expenditures paid or incurred in 2012 to provide access to your business for individuals with disabilities, and this would include a rental home. You can also deduct up to $15,000 of qualified costs paid or incurred during the year to remove architectural and transportation barriers to individuals with disabilities and the elderly. But you cannot take both the credit and the deduction for the same expenditure. For more information, refer to IRS Publication 535, Business Expenses, for more information. The first line we're going to take a look at on direct expenses is auto and travel, line 6. You can deduct ordinary and necessary auto and travel expenses related to your rental activities, including 50% of meal expenses incurred while traveling away from home. You generally can either deduct your actual expenses or take the standard mileage rate. You can use the standard mileage rate for 2012 only if you have not previously claimed depreciation on the vehicle other than straight line depreciation. You owned the vehicle and used the standard mileage rate for the first year you placed that vehicle in service, or you lease the vehicle and you are using the standard mileage rate for the entire lease period. If you decide to claim actual expenses, you include in the rental activity the portion of the following amounts that are attributable to the rental activity: gasoline, oil, repairs, insurance, tires, etc. If you have auto rental expense or lease payments, you would enter auto rent expense on line 19 and depreciation on line 18. If you take the standard mileage rate, multiply the number of miles you drove your auto in connection with your rental activities by 55.5 cents per mile for 2012, and it will be 56.5 cents a mile for 2013. Also on the auto expense line, you can claim any expenses you paid with relation to the rental property for parking, fees, and tolls. Now, one of the things that does go on with Schedule E that a lot of people aren't aware of is that the Schedule E does not provide space the way Schedule C does to provide information about the business use of the vehicle. If you think mentally about Schedule C, and of course we'll be looking at Schedule C in detail on Thursday's class, but Schedule C has space on page 2 to provide required information about usage of a vehicle. The IRS wants to know the total miles put on the vehicle for the year. It wants to know the commute miles. It wants to know the business miles. It wants to know if you have another car available for use. It wants to know if you have records to prove your business use. All of those disclosure questions and information need to be provided to the IRS whenever you claim car expenses. But Schedule E does not provide space to provide that information. So if you are claiming an auto expense on Schedule E, the only way you can provide IRS with that required information is by attaching Form 4562 to the tax return. So 4562 is required if you claim auto expenses. You need to attach it to your return. And on Part 5 of Form 4562, you provide all of the required information about usage of the vehicle. Line 10 is where we enter legal and professional fees, and you include the following expenses on line 10. Fees for tax advice and preparation of tax forms related to your rental real estate or royalty properties, but the following expenses are not reported on line 10. Legal fees paid or incurred to defend or protect title to the property, to recover property, or to develop or improve the property. These costs must be capitalized and added to the property's basis. Line 12, mortgage interest paid to banks, etc. If you have a mortgage on your rental property, enter on line 12 the amount of interest you paid in 2012 to banks or other financial institutions. Do not deduct prepaid interest when you paid it. Points paid to purchase, improve, or refinance property must be amortized over the life of the loan. Note that if you report interest on line 12 for which there is no corresponding 1098 document, that could trigger an IRS audit. So on the Schedule E, I'm just going to back up to that expense line. You can see right here, line 12, it provides space for mortgage interest paid to banks. See instructions. And what the instructions are telling you is that your client needs to have a 1098 with their name and social security number on it. If they don't have a 1098 with their name and social security number on it, and then you enter the mortgage interest relating to that rental property on line 12, the IRS is going to be looking to match a 1098 to back up the amount claimed on line 12. And if no 1098 is issued, your client's probably going to get a CP2000 letter. And it's probable that it will happen because I've had clients where that has happened, that the Schedule E listed expenses for interest on line 12, but either there was no 1098 or the 1098 was in a different social security number, or maybe in the EIN of their LLC along those lines, and IRS hasn't been able to match it to the return. And when that happened, they got a CP 2000 letter, and then we had to address it to the IRS and say, yes, this really is an expense. So what you're supposed to do if you don't have a 1098 is you would enter the mortgage interest on line 13 instead, and then IRS won't be looking for that match. So line 13 is where you enter other forms of interest that did not have a 1098 corresponding to them. Line 14, repairs. You can deduct the cost of repairs made to keep your property in good working condition. Repairs generally do not add significant value to the property or extend its life. Examples of repairs are fixing a broken lock or painting a room. Improvements that increase the value of property or extend its life, such as replacing a roof or renovating a kitchen, must be capitalized and depreciated. Utilities. You can deduct the cost of ordinary and necessary telephone calls related to your rental activities or royalty income. For example, calls to the renter. However, the base rate, including taxes and other charges for local telephone service for the first telephone line into your residence, is a personal expense and is not deductible. This is an old rule. It's been around a long time. IRS says that you cannot claim a deduction for the first landline into your home. Never mind the fact that most people have cell phones and don't even have landlines anymore. If you do have a landline, you're not allowed to deduct it unless you have two landlines or unless you can show you incurred additional expenses that are directly attributable to the rental. Say, for example, long-distance charges, or maybe you have call waiting so that you can receive a phone call from your tenant if they absolutely have to break into you and get to you. Line 18 is for depreciation expense or depletion. You begin depreciating your property on the first day it is available for rent, and if you purchase a property and do not make it available for rent until you complete improvements or repairs, the cost of these repairs and improvements is added to the basis of the property. Form 4562 must be attached to your tax return if any of the following is true. This is the first year that the property is available for rent. In other words, this is the year you decided to begin renting your property. You're going to have to file a Form 4562 with the return to tell the IRS that you have placed the property in service as a rental property. You also need to file Form 4562 if an improvement was made to the property during the year, or you are claiming depreciation on any listed property regardless of the date it was placed in service, and I already mentioned that it's also required if you had auto expenses during the year. Land and buildings. If you buy buildings and your cost includes the cost of land on which they stand, you must divide the cost between the land and the buildings to figure the basis for depreciation, basically of the building. So when you purchase land, a vacant land, there's no building on it. There's nothing to depreciate it because land is not depreciable. So, for example, maybe you're renting farmland. There's nothing on the land. There's nothing to depreciate. You just have income and no depreciation. It's possible with farmland. Sometimes also at a commercial level, people will purchase land in a commercial area or an area that's zoned as commercial or retail, and then they will lease that land to businesses that then build buildings on them. So it's possible for a business to own a building and not the land that's sitting under it, and it's also possible for rental income to come from land on which there is buildings, but the land and the buildings are owned separately. But there's also situations where, most commonly, you purchase the land and the building together. The building is already on the land. But the IRS says that the land itself is never depreciable, and so it's important to do a determination at the time you purchase the property and place it in service of what the land value is. And to the extent there is land value, you cannot depreciate that. Now, if you are not certain of the fair market value of the land and the buildings on it, you can divide the cost between them based on their assessed value for real estate tax purposes. And here's an example of something that you can do to determine land value. Because typically, if you get a new client, they've got a property that they've placed in service as a rental property, and you say to them, okay, you say that you paid $200,000 for the property. How much is the land worth? And the client's going to go, I don't know. Because even when you get an appraisal done, the appraiser just gives a total value on the property. They don't give a value from the land and a value for the structure typically. I suppose they could, but I've never seen it done that way. So how do you give a value? Well, this is a system that I use because it makes sense. And the IRS says if the system you use makes sense, then it's a good system and they will accept that. You buy a house and land for $100,000. The purchase contract does not specify how much of the purchase price is for the house and how much is for the land. The latest real estate tax assessment on the property was based on an assessed value of $80,000, of which $68,000 is for the house and $12,000 is for the land. You can allocate 85%, that's $68,000 divided by $80,000, of the purchase price to the house and 15% of the purchase price to the land. Your basis in the house would therefore be 85% of $100,000, and your basis in the land would be 15% of $100,000. So even though the property tax assessment says that the entire property is worth $80,000, the property tax assessment is providing you with a ratio that you can apply to the property as a whole. And using that ratio, you come up with a depreciable basis for the building of $85,000 and a non-depreciable basis in the land of $15,000. Basis other than cost. There are many times when you cannot use cost as a basis. You cannot use cost as a basis for property that you received in return for services you performed, in an exchange for other property, as a gift from your spouse or former spouse as the result of a divorce, or as an inheritance. If you received property in one of these ways, you should read Publication 551, Basis of Assets, for information on how to determine your basis. And we also talk about this in Pacific Northwest Tax School's course called Basis of Assets. We go into different methodologies for figuring basis in those types of situations. Adjusted basis. Before you can figure depreciation allowed on a house, you may have to make certain adjustments, that is, increases or decreases to the basis of the property. The result of these adjustments to the basis is called the adjusted basis. So what are some things that it can increase basis? Well, you must increase the basis of property by the cost of all items properly added to a capital account. And this includes things like the cost of any additions or improvements having a useful life of more than a year, amounts spent after a casualty to restore the damaged property, the cost of extending utility service lines to the property, and any legal fees you paid, such as the cost of defending and perfecting title that relate to the property as a whole. Additions or improvements. Add to the basis of your property the amount an addition or an improvement actually cost you, including the amount you borrowed to make the addition or improvement. This includes all direct costs such as material and labor, but not your own labor, only labor that you paid money to other people. It also includes all expenses related to the addition or improvement. Examples of expenses related to an addition or improvement might be, you had an architect draw up plans for remodeling the property. The architect's fee is a part of the cost of the remodel. Or if you had your lot surveyed to put up a fence, the cost of that survey is a part of the cost of the fence. Keep separate accounts for depreciable additions or improvements made after you place the property in service in your rental activity. So let's just suppose in 2011 you put your property into service as a rental property. You have a depreciable basis in the structure of $100,000 and you begin depreciating $100,000. Then in 2012 you put a new roof on the property and the new roof costs you $5,000. You would now have another line for depreciation on the rental property for the roof, and that roof would have a placed in service date that is 2012 rather than 2011 when the structure itself first was placed in service. The cost of landscaping improvements. This is one that always kind of bothers me because I think IRS has made it confusing. The cost of landscaping improvements is usually treated as an addition to the basis of land, which is not depreciable. If the landscaping improvement is adjacent to the home rather than separate from it, then the landscaping may be depreciable, usually over a period of 15 years. So the IRS says land and anything attached to the land typically is not depreciable. And that includes plants that you might plant on the land. But then on another page, they say, well, if you did improvements to the land, they typically are depreciated over 15 years. So what is it? Is it depreciable or non-depreciable? And essentially, the message I've gotten in talking to IRS auditors and specialists at IRS on this matter is that if the improvement is so close to the house that if you were to go in and demolish the house, there'd be no way to avoid damaging the property immediately around the house, the improvements to the land immediately around the house, then those improvements are depreciable, typically over 15 years. But if you've got a house, or say a farmhouse, and then way off in the distance you have other land improvements, the IRS is saying that they may not be depreciable. Assessments for local improvements. Assessments for items which tend to increase the value of property, such as streets and sidewalks, must be added to the basis of the property. For example, if your city installs curbing on the street in front of your house and assesses you and your neighbors for the cost of the curbing, you must add the assessment to the basis of your property. You also add the cost of legal fees paid to obtain a decrease in an assessment levied against the property to pay for those local improvements. You cannot deduct these items as taxes paid or depreciate them. Assessments for maintenance or repairs or meeting interest charges are deductible as taxes. Do not add them to the basis of your property. I wanted you to take a look at the classwork assignment, which is back on page 64 of the manual. I'm just going to flip there real quick. This is a classwork assignment that by the time we're finished with it today is going to really encompass most of the different topics we're talking about in today's class. It involves preparation, of course, of a 1040, Schedule E page 2, a 4562, a 6198, and an 8582. And what I'd like you to do is analyze the expenses that we have listed in here for Rudolph Deer and start to work on his Schedule E. And here is the story for Rudolph. On January 2012, Rudolph bought a condominium apartment to live in, and instead of selling the house he had been living in, he decided to convert it to rental property. Rudolph selected a tenant and started renting the house out on February 1st. He charges $1,200 a month for rent and collects it himself. He also received a $1,200 security deposit from his tenant that he plans to return at the end of the lease. Rudolph had the following expenses for the house for the year: mortgage interest, fire insurance, miscellaneous repairs, real estate taxes, auto expenses. Rudolph bought his house in 2002 for $100,000, and at that time $33,000 was allocated to the land and $67,000 was allocated to the house. Before changing the home to rental property, Rudolph made the following improvements. He remodeled a kitchen at $5,000, added a rec room, he put on a new roof, a patio, and a deck. On February 1, when Rudolph changed his home to rental use, the property had a fair market value of $150,000, $50,000 for the land, and $100,000 for the house. Because Rudolph's adjusted basis is less than the fair market value on the date of the change, Rudolph must use his adjusted cost basis for figuring his depreciation. On April 1, 2012, Rudolph bought a new dishwasher for the rental property at a cost of $450. The dishwasher is personal property used in a rental real estate activity, and it has a 5-year recovery period. He's going to use the half-year convention to figure his depreciation. On June 1st, Rudolph installed a new central air conditioning system and a furnace in the house. The cost of the units and the installation was $4,500, and those will be depreciated over 27.5 years. Now, rather than force you to figure all of the depreciation manually for Rudolph, we've given you his pre-prepared depreciation schedule. You should take the information on this to correctly fill out his 4562 and also to fill out the depreciation amount on his Schedule E. Rudolph received a W-2 and 2 Schedule K-1s. His W-2 is shown here. With regards to the Schedule K-1s, he is an active partner in Toymakers, Inc., and he has a capital account in Toymakers, Inc. at the beginning of the year that is $0, but he did contribute $2,000 to the business. He also is a passive partner in Reindeer LLC, and his capital account is accurately reflected on that Reindeer LLC Schedule K-1. So it's a little bit early for me to be making you do anything with the K-1s. We're going to get to those a little bit later in today's class, but I'd like you to start whittling your way through some of the expense items listed here and kind of poking away at Schedule E and doing the best job you can of getting some numbers on there. Transporter, T-R-A-N-S-P-O-R-T-E-R, transporter. I'm just reading through the chat. There was a chat here regarding auto expenses. If you are claiming the actual expenses based on business miles versus total miles, if so, will following years change the deduction percentage for depreciation based on the change of business versus total miles? Well, the answer is yes. Each and every year, your business use percentage is going to vary, and you're going to have to track that. And how you track it is with a mileage log. So a mileage log is not an option. You're required to keep a log, show the personal use versus the business use, and then you figure percentages of all of those deductions. I believe it's in our depreciation class we take a look at how you track those, but ultimately in any business venture where you're using a vehicle, if your client gets audited by the IRS and they don't have a mileage log, Any deduction they claim for that car is going to get thrown out. It's the first thing the IRS asks for, and it's the first thing they'll throw out a deduction for if proof of that deduction cannot be presented. And of course, they accept a mileage log as proof of that deduction. And it can be a computerized one or a hand log, but there needs to be a log. And I've never really had an IRS auditor question a log either. Every audit I've ever been in, they ask for the log. If they get the log, they look at it, they peruse through it a little. They may also ask for things like maintenance records. Say you take your vehicle to Jiffy Lube 3-4 times a year to get the oil changed. They may ask to see receipts from Jiffy Lube with odometer readings on them, just so that if you're saying you drove your car 20,000 miles during the year, that independently there's been a verification done that you really did put 20,000 miles on the vehicle during the year. But aside from that type of scrutiny, looking for some outside source for verifying total miles, I've never had an IRS auditor really question the log itself. And if a log is presented, they've typically been happy with that. But yeah, business percentage use would change year to year. Of course it would. Then the next question is, you're asking me what something in Pro Series means, and I don't use Pro Series. So what I can tell you is that when you're using tax software, the software is going to ask you the type of activity that you were reporting on Schedule E or on Schedule C, and it will ask you whether it's a passive activity, and if it is a passive activity, what kind of passive activity it is. And we're going to get into that later on in today's class so that you can learn to identify when an activity is passive and whether it would be subject to the limits on passive activity losses. And then I see a question, oh, that makes you a real estate professional? Well, yeah, we'll get into real estate professionals later on as well. So let's get into deducting versus capitalizing. So let's pick up here. So deducting versus capitalizing costs. You cannot add to your basis costs that are deductible as current expenses. However, there are certain costs you can choose to either deduct or capitalize, and if you capitalize these costs, you include them in your basis. If you deduct them, do not include them in your basis. The costs you may be able to choose to deduct or to capitalize include carrying charges such as interest and taxes that you must pay to own property. Decreases to basis. You must decrease the basis of your property by any items that represent a return of your cost. These includes the amount of any insurance or other payment you receive as a result of a casualty or theft loss. Any deductible casualty loss is not covered by insurance. And any amount you receive for granting an easement is also a decrease to basis. Also, residential energy credit, you were allowed if you added the cost of the energy item to the basis of your house. So let's just suppose you put solar panels on the house. That's a cost, and you would capitalize that cost. But if you were allowed to claim a credit against the cost of that improvement, then you're going to reduce your basis again by the amount of the credit. The amount of depreciation you could have deducted on your tax returns under the method of depreciation that you selected. If you took less depreciation than you could have under the method that you selected, you must decrease the basis by the amount that you could have taken under that method. Now, what's that about? Well, it's not uncommon, quite frankly, for me to see a tax return where there is rental income and expenses being reported, and there's never been a deduction for depreciation. I've also seen the opposite where there's been deductions for depreciation, but there's never been an allowance for land value, and so depreciation deductions have been being claimed against the land value. And both of those are inaccurate. IRS says you need to figure your depreciation correctly, and you need to claim it correctly. It's required. Now, if you deducted more depreciation than you should have, you must decrease your basis by the amount that you should have deducted, plus the part of any excess you deducted that actually lowered your liability for any year. But if you should have claimed depreciation and did not, the IRS still says you need to reduce your basis by the amount of depreciation you could have claimed and did not claim. Now, basis of property changed to rental use. When you change property you held for personal use to rental use, for example, you rent out your former home, you figure the basis for depreciation using the lesser of the fair market value or the adjusted basis. Fair market value is the price at which the property would change hands between a buyer and a seller, neither having to buy or sell, and both having reasonable knowledge of all the relevant facts. Sales of similar property on or about the same date may be helpful in figuring the fair market value of the property. Figuring the basis. The basis for depreciation is the lesser of the fair market value of the property on the date you changed it to rental use, or your adjusted basis on the date of the change. That is, your original cost or other basis of the property plus the cost of permanent additions or improvements since you acquired it, minus deductions for any casualty or theft losses claimed in earlier years' income tax returns and other decreases to basis. So let's take a look here where fair market value could be less than basis. And there's been a lot of this going on here because, of course, for many, many years, the thought of property dropping in value was kind of, is that possible? And yes, it is possible. There's various times in even my lifetime where I can remember huge crashes in the real estate market. There was a crash in the 80s, and there was, of course, a big crash in 2008 in the real estate market. It kind of even started at the end of 2007. And when real estate drops in value, that's an important thing to be taking note of, because if you have a client that converts a house to rental use, their depreciable basis in that house is going to be the lesser of their cost or the value of that property on the date they convert it to rental use. And of course, a lot of people made the decision to convert their homes to rental use after 2008 because they couldn't afford to sell them and they couldn't afford to live in them either. So they were looking for any way to try and make ends meet. And the basis for depreciation is going to be the lesser of those two numbers. So let's just take a look at an example of how that would work. Several years ago, you built your home for $140,000 on a lot that cost you $14,000. Before changing the property to rental use last year, you added $28,000 of permanent improvements to the house and claimed a $3,500 deduction for a casualty loss to the house. Because land is not depreciable, you can only include the cost of the house when figuring the basis for depreciation. The adjusted basis of the house at the time of the change in use was $164,000. You figure that by taking the original cost of $140,000, adding the permanent improvements you made to the house of $28,000, and then subtracting out that $3,500 casualty loss. When you do all of that, you get a cost basis for depreciation of $164,500. Now, on the date of the change in use, your property had a fair market value of $168,000, of which $21,000 was for the land and $147,000 was for the house. The basis for depreciation on the house is going to be the fair market value of the date of change, $147,000, because that is less than your adjusted basis. MACRS depreciation under GDS. Now, today's class is about rental property, and we're going to be showing you some of the depreciable life under the general depreciation system. But I did want to point out that one error that I see almost universally made every time I look at a tax return that has a rental property that is foreign, the wrong depreciation system has been chosen. So I'm about to show you all of the depreciable life for assets being depreciated under the general depreciation system. The general depreciation system only applies to property inside of the United States. So if you are preparing a rental tax return, a Schedule E, for a client who has a rental property in a country outside of the United States, such as Canada, England, Mexico, Europe, anywhere except the United States, then you have to use the alternative depreciation system. And under ADS, by comparison, you would depreciate all rental property that is real estate over 40 years, not 27 and a half years. And also, commercial real estate is depreciated over 39 years. So only residential rental property located inside of the United States is depreciated over 27 and a half years. Commercial property inside of the United States is depreciated over 39 years, and rental property, whether it's residential or commercial, that is located outside of the United States is depreciated over 40 years. So under MACRS, which is what we're going to talk about now, you figure your depreciation under the general depreciation system in one of two different ways. The deduction is substantially the same in both ways, and the difference, if any, is slight. You can either compute the deduction using the depreciation method and convention that applies over the recovery period of the property, or you can use the percentage from the optional MACRS tables. Well, when I figure depreciation, I typically do it manually. I don't open up the tables. I just take the recovery period of the property, I apply the convention, and I figure that depreciation manually. It keeps me on my toes. Or I let the software do it for me, and then, of course, I do it manually to figure if the software is spot on. But typically the software, what I've noticed is it does pull numbers from the tables, and so if I figure depreciation longhand manually, I may come up with a slightly different number than the software does. And IRS says that's okay. You're allowed to use either method, that is to figure it longhand, applying the rules for depreciation, or to use the tables, which are a quick method of applying the rules. If you compute the deduction, The depreciation method you use depends on the class of property. And we've got different types of property here. Firstly, we have computers and their peripheral equipment. IRS says that that's 5-year property. Under ADS, it's 5 years. Office machinery such as typewriters, calculators, and copiers, 5 years. Automobiles are 5 years. Light trucks are 5 years. Appliances such as stoves and refrigerators used in a rental property are 5 years. Carpet, 5 years. Furniture used in rental property is also 5 years. But office furniture and equipment such as desks and file cabinets is 7 years. And any property that has not been given a class life and that has not been designated by law as being in any other class is 7-year property. Roads are 15 years, shrubbery 15 years, fences 15 years. Residential rental property, buildings or structures and structural components such as furnaces, water pipes, venting, etc. is 27.5 years. And additions or improvements such as a new roof, those take on the same recovery period as the property to which the addition or improvement is made. And so you determine depreciation as if the property were placed in service in the same time as the addition or improvement. Now, if you place an addition or improvement in service in a later year, of course, you'll go with the date placed in service. But if you made additions or improvements to your home and then you began depreciating the home, then you would not separate those out, and they're all treated as placed in service at the same time. 5, 7, or 15-year property. For property in the 5 or 7-year class, use the 200% declining balance method and a half-year convention. However, in certain situations, you must use the mid-quarter convention if it applies. And for property in the 15-year class, you need to use 150% declining balance method and a half-year convention. You can also choose to use the 150% declining balance method for property in the 5 or 7-year classes. But if you decide to use 150% declining balance for a property in a 5 or 7-year class, you must do so for all property placed in service in that year in that same class. To make the election, you complete Form 4562, and in Part 3, in Column F, you would enter 150 dB instead of 200 dB. Now, this is a lot of terminology, and if it's going over your head, you don't understand what I'm talking about, then I recommend you go take our course called Depreciation Made Easy. I did teach that a couple of weeks ago, and it is on the schedule to come out as a webcast mid to late July. Depreciation will be available as a webcast where you can come in and take that particular course. And in Depreciation Made Easy, we go into all of the rules about how to calculate depreciation. But just as a refresher, and for those of you who still feel fairly comfortable about depreciation, the IRS in Publication 527 goes out of its way to describe these depreciation rules, and that's why I'm bringing them up again here. Now, if you use either the 200% or the 150% declining balance, you figure deduction using the straight line method in the first tax year that the straight line method gives you an equal or larger deduction than 200% or 150% declining balance. You can also choose to use the straight line method with a half-year or mid-quarter convention for 5, 7, or 15-year property. The choice to use the straight line method for one item in a class of property applies to all property in that class that is placed in service during the year of the election. You elect straight line method on Form 4562 in Part 3, and in Column F you would enter straight line. Once you make the election, you cannot change to another method. Special depreciation allowance. We've had bonus depreciation in place off and on for the past decade. The first year bonus depreciation came into play was following 9/11 in 2001. And it first came into being that we had 30% depreciation, and then after a period of time, the IRS brought in 50% bonus depreciation. And then we had no bonus at all for a number of years. And then we had bonus returned to us again with 50 followed by 100%. There was 75, was there 75%? I'm trying to remember. But there was definitely 50 and definitely 100%. For 2012, we're at 50% bonus. And the point of all of this is that bonus depreciation is allowed for use in rental properties. So if you have a residential or a commercial rental property, you are allowed to claim bonus depreciation on that. However, you are not allowed to claim a Section 179 deduction on rental property. So if you purchase a new appliance for your residential rental property, a new stove, say, and you put that new stove in, it would be eligible for bonus depreciation, and it would also be eligible for 200% declining balance depreciation, but it would not be eligible for a Section 179 deduction. And if you're preparing for any kind of IRS exam, that Section 179 question is probably going to be on there with respect to rental property, and the answer is just no, no, no. Depreciation method and convention, you must use the straight line method and a mid-month convention for residential and non-residential rental property. That's for the structure itself. Claiming the correct amount of depreciation. You should claim the correct amount of depreciation each year. And if you do not claim all the depreciation that you were entitled to deduct, you must still reduce your basis in the property by the full amount of depreciation that you could have deducted. If you deducted an incorrect amount of depreciation for property in any year, you may be able to make a correction by filing Form 1040-X, which is an amended return. If you are not allowed to make the correction on an amended return, you can change your method of accounting to claim the correct amount of depreciation. If you are going to file an amended return, there are some rules. You can file an amended return to correct the amount of depreciation claimed for any property in any of the following situations. You claimed an incorrect amount because of a mathematical error made in any year. You claimed the incorrect amount because of a posting error made in any year. You have not adopted a method of accounting for a property placed in service by you in any years ending after December 29, 2003, or you claimed the incorrect amount on the property placed in service by you in tax years ending before December 30, 2003. If an amended return is allowed, you must file it by the later of the following dates: 3 years from the date you file your original return for the year in which you did not deduct the correct amount. A return filed before an unextended due date is considered filed on that due date, or 2 years from the time that you paid your tax for that year. So what I commonly run across, there's two scenarios which I described earlier. One scenario is no depreciation was claimed at all, and the other is that the wrong life has been given to an asset, that the asset is maybe perhaps foreign rental property. And I can see that the tax preparer who's been handling that return before it came to me has been depreciating that property over 27.5 years, even though it's in a foreign country. And because it's in a foreign country, it should have been depreciated over 40 years. That is an error. It's an accounting method error. It's an incorrect accounting method error. So that should be corrected. The other side is, of course, where people just don't depreciate their property at all. And very often it is the owner of the property that's saying, I don't want to depreciate it. I don't want to deal with that hassle. I don't want to claim that deduction. I don't want to reduce my basis in the property. The problem is that the IRS says whether you claim depreciation or not, if you could have claimed it and you didn't, then you will be treated as having that reduction in your basis anyway. So if you owned a property for 20 years and you should have claimed $50,000 of depreciation on it in those 20 years, but you didn't claim any depreciation, the IRS is going to reduce your basis in that property by $50,000 anyway. So what do you do about that? Can you correct for that? And the answer is yes. You do so by filing a change in accounting method. And to file for a change in accounting method, the IRS says that you really need to have adopted an accounting method, and they describe, basically this is how they say you adopt an accounting method. Generally, you adopt a method of accounting for depreciation by using a permissible method of determining depreciation when you file your first tax return for the property that is used in your rental activity. This also occurs when you use the same impermissible method of determining depreciation in 2 or more consecutively filed tax returns. So IRS says if you choose a method of accounting and the method of accounting or figuring depreciation is wrong, and you use that wrong method 2 years in a row or more, then you can file for a change in accounting method and correct that depreciation. Now, what happens is that the IRS ultimately, in the year you file for that correction, will allow you to correct all of the depreciation in one time on your Schedule E. It isn't that you adjust your basis doesn't change. If you should have claimed a certain amount of depreciation and you didn't do it, say that $50,000 of depreciation you should have claimed but you never did, in the year you file for that change in accounting method, the IRS is going to allow that depreciation to be claimed as an expense. So it's a pretty interesting scenario, a fairly complex piece of work to make it happen. I've done it a few times over the years. It involves a bunch of manual calculations and completing a manual statement that is attached to Form 3115, and then Form 3115 is filed with the tax return or separately from the tax return with the IRS to apply for that change in accounting method. Line 19, other expenses. And I do see a couple of questions up here. For an addition to residential real estate, do you start the 27.5 years at the time of placing the addition in service, which means its life would go past the life of the original structure? That's what I'm saying. So let's just suppose you have a residential rental property, you placed it in service 10 years ago. And then in 2012, you put in a new heating and air conditioning system at a cost of $5,000. Well, that new heating and air conditioning system, from that day you placed in a service, is going to have a life of 27.5 years for depreciation. And so, yes, it would be 10 years behind on the depreciation cycle. Absolutely. And then the next question is, did you say you could claim bonus on real estate? The answer is you can claim bonus depreciation on certain assets used in real estate. So, for example, if you purchase a new stove and place that stove in service in your rental property, that stove is eligible for bonus. But bonus depreciation applies only to assets with recovery periods, I believe, of 20 years or less. So the structure itself, or a heating and air conditioning system that becomes a part of the structure, would not be eligible for bonus. But smaller things like new carpet, new fixtures, new appliances, a fence, those would be eligible for bonus. Line 19, other expenses. Enter on line 19, ordinary and necessary expenses not available or not given a line anywhere else. So line 5 through 18, you've got places to put expenses. And if you've got an expense that just doesn't seem to fit on any of those lines, that's what line 19 is for. You know, there's a line for repairs and maintenance, but not really a line for landscaping, or landscaping could be an improvement. Let's just say yard maintenance. You might put yard maintenance under maintenance, or maybe you'll just give it its own line. Either is fine. I find it simpler to add lines and clearly define things. I prefer to have lots of descriptions so I know what something really is. Also, on line 19, you may be able to deduct part of the cost of modifying existing commercial buildings to make them energy efficient. That's just an annotation that IRS has in the instructions for Schedule E specific to line 19. And then line 20, you're going to total up all of your expenses. So you go through lines 5 through 19, you add them all up, and you enter the total on line 20. And you would do that for each individual property going across the line. Then we move on to line 21. Subtract line 20 from line 4. If the total is a loss and you have amounts that you are not at risk for, you now need to complete Form 6198 to determine the amount of your deductible loss. Enter the amount in the appropriate column on line 21 of Schedule E, and in the space to the left of line 21, enter Form 6198, and then attach that form to your return. Line 22, deductible rental loss. Do not complete line 22 if the amount on line 21 is from royalty properties. If you have a rental real estate loss from a passive activity, the amount of loss you can deduct may be limited by the passive activity loss rules. You may need to complete Form 8582, Passive Activity Loss Limitations, to figure the amount of loss, if any, that you are allowed to enter on line 22. And if your rental real estate loss is not from a passive activity, or you meet the exception for certain rental real estate activities, you do not have to complete Form 8582. So we're going to talk all about that a little bit later. Right now we're just going through the form itself. We'll get into those details in a bit. Line 23 is the total of all of the amounts. And this is a change that I saw for 2011 and again for 12, that IRS added these lines and asked you to specifically pull out certain totals and add them up. IRS wants you to enter on line 23A the total of all income amounts on line 3. And on line 23B, it wants you to end up all of the income amounts for any royalty properties. On 23C, it wants you to total up all of the mortgage interest amounts that are shown on line 12. That's basically IRS saying, hey, what was on all those 1098s? And if you have a total on line 23C, it should not be more than the amounts of the 1098s that you're holding for your client. And then line 23D, enter the total of all depreciation amounts reported on line 18 for all of the properties. And then finally, line 23E, enter the total of all expense amounts reported on line 20 for all of the properties combined. Line 24 is where you enter income. Enter the total of all positive amounts on line 21. Do not include any losses. And then on line 25, add the total of royalty losses from line 21 and total rental losses from line 22 and enter them here. So if your property has a profit, enter that profit on line 24. If your property has a loss, enter that loss on line 25. Line 26, total rental real estate and royalty income or loss. Enter the total rental real estate and royalty income or losses by combining lines 24 and 25. And then if parts 2, 3, and 4 and line 40 on page 2 do not apply to you, also enter the amount from line 26 onto Form 1040, line 17. So what's essentially saying is if you're not subjected to any of the limits that would prevent you from claiming your rental real estate losses, you'll just carry those losses or your royalty losses over to line 17. But if you are subjected to limits, then you're going to have to fill out page 2 and apply the limits. Deducting rental losses, your ability to deduct rental or royalty losses on Form 1040 may be limited by either or both of the following: at-risk limitations and passive activity loss limits. If your losses are limited, you will have a carry forward to the next year. So that's a summary of the Schedule E and essentially how to fill out each line, the reason that the line is there. IRS wants you to put certain expenses on each line. Now we're going to get into some more of kind of the brain teaser things when I'm preparing a tax return. How much was property taxes? Enter that on the property tax line. That doesn't require a whole lot of careful thinking. But some of the other aspects that I'm about to talk about do kind of puzzle the mind, and when you are preparing a Schedule E, it's important to remember these rules and make sure when you analyze your tax software that it's doing what it's supposed to with the numbers that you are entering. Firstly, let's look at the concept of you have a rental property and you're not even renting it for a profit. IRS says that if you do not rent your property for a profit, you may deduct rental expenses only to the extent of rental income. And you report your not-for-profit rental income on line 21 of Form 1040 as other income. And you then claim expenses up to the amount of your income on line 23 of Schedule A as a miscellaneous deduction subject to the 2% limit of your adjusted gross income. So if you're not operating your property for a profit, you shouldn't even be using Schedule E, is essentially what IRS is saying. Property change to rental use. If you convert your home or other property to rental use at any time after the beginning of your tax year, you must prorate your expenses between personal use and rental use. You deduct your prorated allowable expenses such as mortgage interest and property taxes on Schedule A, and then you deduct your prorated rental expenses on Schedule E. And here is an example where proration would be required. You convert your home to rental use on April 1st, 2012. You claim property taxes and mortgage interest you pay on your home prior to April 1st on Schedule A, and then you claim rental expenses paid on your home from April 1st forward on Schedule E. Renting part of property. This is the concept where you have a roommate or perhaps you have a duplex. If you rent part of your property, you must divide certain expenses between the part of the property used for rental purposes and the part of the property used for personal purposes, as though you actually had two separate pieces of property. You can deduct the expenses related to the part of the property used for rental purposes, such as home mortgage interest, qualified mortgage insurance premiums, and real estate taxes as rental expenses on Schedule E. You can also deduct as rental expenses a portion of other expenses that normally are non-deductible personal expenses, such as expenses for utilities, home maintenance, and repairs. If you itemize, you can claim as an itemized deduction on Schedule A the personal use portion of expenses you pay for home mortgage interest, mortgage insurance, and real estate taxes, but obviously not for any of those other utility type expenses. If you have a phone, you cannot deduct any part of the cost of the first phone line in your home, even if your tenants have unlimited use of it. If you provide a second phone line for your tenant, you can deduct the cost of that second line. Direct expenses are not divided. You do not have to divide the expenses that belong only to the rental part of your property. Examples of direct expenses include things like painting a room that you rent, payment of premiums for liability insurance in connection with renting a room in your home, installing a second phone line strictly for the tenant's use. All of the cost of that second line is deductible as a rental expense. And depreciation on the part of the house that is used for rental purposes, as well as on the furniture and equipment you use for rental purposes. How do you divide the indirect expenses? If an expense is both rental use and personal use, such as mortgage interest or heat for the entire house, you must divide the expense between the rental use and the personal use. You can use any reasonable method for dividing the expense. It may be reasonable to divide the cost on some items, for example water, based on the number of people who are using them. The two most common methods, though, for dividing expenses are the number of rooms in the home and the square footage of your home. Duplexes are a common situation where you have to do a division of expenses, and that's where you live in one unit and you rent out the other. Certain expenses would apply to the entire property, such as mortgage interest and real estate taxes, and then you would need to split those to determine the rental and personal portion of them. And here is an example of division of expenses on a duplex. And I believe I got this one straight out of publication 527. This is IRS's illustration. You owe a duplex and live in one half, renting out the other half. And both units are approximately the same size. Last year, you paid a total of $10,000 of mortgage interest and $2,000 of real estate taxes for the entire property. You can deduct $5,000 of mortgage interest and $1,000 of real estate tax on Schedule E. And if you itemize your deductions, you can claim the other $5,000 of mortgage interest and $1,000 of real estate taxes on Schedule A. And I have a more comprehensive example coming up now. We're going to show you how these numbers fit together to become deductible on Schedule E. Lightning McQueen is the character in this story, and he owns his own home. He has a roommate named Mater, and Mater rents a room and a bathroom for his exclusive use. Mater shares other common areas of the home with Lightning, and there are also areas of the home which are exclusively used by Lightning. You can just imagine that situation. You've got a house, 3-bedroom house, you're renting out a bathroom and a bedroom, and then you share the kitchen and the living room. And then the other bedroom or a couple bedrooms are for you. So it's easy to conceive of how that would come together. Lightning would need to prorate his expenses between personal and rental use. His house in this illustration is 2,000 square feet with 3 bedrooms and 2 bathrooms. He has divided the rental personal use as follows. Exclusive use to Lightning is 500 square feet. Exclusive use to Mater is 300 square feet. And joint use by the both of them is another 1,200 square feet. Lightning is going to figure his personal use portion by taking the 500 feet that are exclusive to him and then taking the joint common area and dividing that by 2. And when he does that, he gets 500 plus 600, which gives him 1,100 square feet. So 1,100 square feet out of 2,000 square feet is 55% of the home. That same formula applied to Mater gives us 45%. So rental portion of the use of the home is 45% and personal use of the home is 55%. This means that Lightning will treat all indirect expenses for his rental as 55% personal and 45% rental. Direct versus indirect expenses, what's the difference? Certain expenses you incur in operating your personal rental property will directly relate to the renting of the property, and these are called direct expenses. Expenses you pay that are not directly attributable to the rental portion of your property are called indirect expenses. You can claim 100% of your direct rental expenses on Schedule E, but you must prorate your indirect expenses between Schedule E and personal. And here's an illustration where we allocate direct and indirect expenses. Lightning has determined that his home is 55% personal use and 45% rental use. During the year, he had the following direct and indirect expenses. He made repairs to the tenant Mater's room. The expense is $200, and because it's a direct expense, all $200 is going to be allowed. A second phone line for Mater cost $250 for the year, and that's allowed in full. And finally, he had to advertise, one of those rare situations where you actually have to advertise to get a tenant, $80, and it's going to be all attributable to the tenant, therefore it's fully deductible. And then we have mortgage interest. The expense is $6,000. And we're going to multiply that by 45% to get the amount that's going to be allowed on Schedule E, because the mortgage interest is an indirect expense. Utilities are also indirect. Property taxes are indirect. Maintenance of home and yard is also indirect. And so we multiply each of those numbers by 45% to get the amount that we would enter on Lightning's Schedule E. And then finally, if we were to look at the depreciable basis of the house as a whole and figure depreciation on it, we would have come up with $1,000, but only 45% of that is going to be deductible. That's $450. Now, Lightning will be able to deduct the following amounts on Schedule A. He'll be able to take 55% of his mortgage interest and 55% of his real estate taxes and carry those to Schedule A. Now, the personal use portion of other expenses required to upkeep Lightning's home are non-deductible personal expenses, and they are not deductible on either Schedule A or E. Use of a worksheet such as this one right here can be helpful. Most tax software out there now probably has indirect and direct columns that you can make entries in so that the software can determine where to carry numbers to. The software we use is Drake Software, and when I enter these amounts in Drake Software, it asks me to indicate what percentage of the home is occupied by the owner of the property, and then it uses that information to do allocations. And if I have a direct expense, I make sure I enter it in the direct column, and then the software will carry 100% of it over to the Schedule E. And if I have an indirect expense, I enter it in the indirect column, And so the software says the total amount of mortgage interest is $6,000, $2,700 is carrying to Schedule E, and $3,300 is carrying to Schedule A. The software will make those entries by itself. I don't have to manually do those as long as I've made the percentage allocations correct. But it's also been the case where I've seen for many, many years that software was not doing split or allocation correctly, and that I was manually having to divide these numbers, figure them manually, and enter them separately into the software. So if your software has a worksheet that works well, you can let the software do the work for you, but I wouldn't totally rely on the software. I would make sure that you really know what those manual calculations are, and then when you let the software do the work for you, make sure that it's carrying the numbers that you think it should, because I've seen many times where it's not working correctly. So let's see here. I see some more questions. What about meals that are not due to travel? Can you deduct meals on Schedule E? I have never had a cause to believe that a meal expense was deductible on Schedule E except for travel. Because when you're looking at the deductibility of meal and entertainment expenses, those have to be directly related to a substantial business discussion. And maybe you're interviewing a tenant over lunch and deciding whether or not you want to rent a property to them, but that would be highly unusual. Typically, you make a decision on a tenant for a rental property based on interviewing them and showing them the property and following up with their references and doing a credit check. So I don't know why you would have a meal related to that. Now, if you had contractors in working on the property and you bought them all lunch, I would look at that as a cost of the maintenance or the remodeling that they're doing on the property. I wouldn't be treating that as a meal per se. So I just can't think of a situation why you would have a meal with a rental property that's not travel. You'll have to give me an example where you saw that come up. Okay, Lightning McQueen is our character in the story, and this is his Schedule E. So we did some manual figuring to figure out how much of his expense is going to carry to the Schedule E. We didn't show you what the rents were that he received during the year, but we've plunked a number on line 3 that his rental income for the year is $7,900. And I also wanted to show you some entries that we made here on line 1B and on line 2. On line 1B, we've entered this as a single-family residence, and then we've listed the fair rental days as 365. We're essentially stating that Mater was in the home all 365 days. IRS says that when you have a rental property where you are sharing a part of your home with a tenant, that you treat that as two separate properties. And so we're not going to be saying that any portion of Mater and Lightning living in the same home would be personal use by Lightning. Rather, it's been rented to Mater for the full 365 days, and we're going to enter 365 days of rental use and 0 days of personal use. So I wanted to give you a distinction here between renting part of your property, which is the header up at the top. Let me get to it. We've just had a discussion of renting part of your property. That is, you have a duplex, you live in one half and rent the other, or you have a home and you rent out a room or a couple of rooms in your home. That's renting a part of your property. And we're going to compare that with the next topic, which is personal use of a vacation home or dwelling unit. Take a look again at that classwork assignment. I'm going to put some poll questions up. And if you get through that assignment far enough, you can be answering some of the questions relating to the poll questions. I'm not going to be reviewing Rudolph just yet, so you've got a little while to work on the correct answer for Rudolph. For now, I'm going to hide that particular question, and we're going to take a look at C question number 1. And C question number 1, it stands for Special Enrollment Examination. This is a question that we've pulled from an old IRS C exam. And I wanted to see how all of you would do if I gave you this question to answer. It reads, Jose started renting a house to Bill for $600 per month beginning February 1, 2012. Bill paid $1,200 on January 15, 2012, which included 1 month's rent and 1 month's security deposit. The rent is due by the 5th of the month. The lease specifies that the security deposit would also be used as the final month's rent. Bill pays the rent on the 2nd of each month. In July, Bill also paid $150 for repairs to the air conditioning system, and in September he paid $80 for a roof repair. He deducted the amounts from the rent paid to Jose for those months. Bill was unable to pay December's rent until January of the next year. How much should Jose report as rental income for the year? So essentially what we're seeing in this is we're basically having to do some figure counting here, at least my style is finger counting, to figure out how many months of rent he really did pay. He starts renting on January 15, and he had to prepay 1 month plus a full security deposit for another month. But the last month's rent is essentially going to be included as income because it's not refundable. And then we get to December, but he didn't manage to make the December payment until January. So essentially, if the rent is $600 a month, we've got 11 months that have been collected, and that makes B the correct answer. So we've got 11 times 600 is $6,600. And the fact that the tenant paid some expenses in lieu of rent means that Jose still had rental income in full for each of those months. So that's why B, $6,600, is the correct answer. All right, there was a couple of questions that popped up. I wanted to take a minute to look at these. Oh, yeah, it was on that issue of when could you have meals for rental property? And I said, give me an illustration because I couldn't think of one. Well, you came up with a good illustration. What if the rental property is located outside of the United States? Would meals be deductible? And then my client has several properties and has met with managers, property managers. Well, that would be perfectly reasonable to have a business discussion. You've got several rental properties. You've got property managers. You're meeting with them. You have a lunch meeting. And you'd be basically looking to the deductibility of meals. And they would be deductible, of course, subject to a 50% limit. And I don't know if Schedule E even has a line for meals. So if it doesn't have a line for meals, then that would be a reason to make an entry on line 19 for other expenses. And as for rental property outside of the United States, could you deduct the cost of meals? Well, you can deduct the ordinary and necessary costs of maintaining that property, including a trip out to manage the property. But of course, you couldn't claim a trip to England where you spent 2 weeks traveling and vacationing as a rental property expense if you only spent an afternoon managing the properties. You have to look to the nature of the travel, how much of the travel is due to the rental activity, and make some sensible decisions about what you are able to deduct there. Does per diem kick in on meals? I see no reason why it wouldn't. I've never read anything in relation to Schedule E that says you cannot claim a per diem for your meal expense when you're traveling with relation to your rental property. I certainly always claim it. So business rental property is essentially treated by the IRS as a form of business income. And so all of the rules that they're really applying, like the standard mileage rate and depreciation, those deductions are really coordinating nicely with what you would be entering on a Schedule C. And certainly I haven't read anything that says you can't claim meals. But you can look to the general rule for claiming any kind of a deduction. And the IRS says to claim a deduction, it must be ordinary and necessary for the business activity. So let's take a look now at the next concept that we're going to talk about, and it's very different than from what we looked at with Mater and Lightning, where Mater is a roommate. Now we're looking at you have a rental property, and you hold it as a rental property, but perhaps also as a vacation home. And what happens when there is owner use of a property? So personal use of a vacation home or dwelling unit. You must generally divide the allowable expenses for rental of your vacation home between rental and personal use. However, if you rent your home for fewer than 15 days during the year, you do not need to include the rent you receive in your income, and you do not deduct your rental expenses. Well, I had a really super extreme example of this year. So much so I'm going to have to mention it to you because I felt quite uncomfortable even dealing with it, to the point where I actually called the tax practitioner hotline and got opinions over the phone that confirmed my own. But here was the situation. I have a client, medical doctor, who owns a very nice house in the Columbia Gorge, which is a national scenic area here in the United States with spectacular views. And the house itself is quite glamorous. And a couple of mail order catalog companies rented his house from him for 10 days to use it for a photo shoot. And they paid him $30,000 to rent his house from him for 10 days. And so I'm scratching my head going, well, you rented it for fewer than 15 days during the year. You don't need to report the income because that is what the IRS is saying the instructions are for Schedule E. But I've never seen anything that said, well, if you rent it for just a small token amount or a de minimis amount, it just says if you rented it for fewer than 15 days, you don't have to report the income. And so I called IRS, talked to the people there, and they absolutely confirmed that he does not need to report that income. But what happens if you have the flip situation? Maybe you own a property that is a rental property, and sometimes you use it for personal purposes. Let's just say you've got a beach property. You purchase it because you'd like to be able to use it yourself, maybe for 1 or 2 weeks during the year while you're on vacation, and then the rest of the year you look at it as an income-producing property. And the IRS says as long as you don't occupy that property for more than 14 days during the year or more than 10% of the days that it was rented during the year, that you don't have to treat any part of the use of that property as personal use. But then we get somewhere that's a happy medium in there where it is a vacation property and you do exceed that 10% of days or more than 14 days during the year where it's used for personal purposes, and what do you do in that situation? And the IRS says, well, generally you have to divide the allowable expenses for rental of your vacation home between rental and personal use. And if, however, you rent it for fewer than 15 days during the year, you do not need to include the rent you receive in your income, and you do not need to deduct your expenses. But if we're going to have a situation where it is going to be a rental property and you do need to report the income, how do you go about dividing them? And quite logically, you would divide it in a similar way that we just described before our break when there is a shared use of a house. IRS says that if you use a dwelling unit for both personal and rental purposes, divide your expenses between the rental use and the personal use based on the number of days used for each purpose. So for a shared home, the IRS says, look at the percentage of the home that is occupied by the tenant and the percentage that is occupied by you. But when we go over to personal use of a dwelling, now the IRS isn't interested in how much of the property that you used. It wants to know how many days you used the property and how many days it was rented, and that's how it's going to get the ratio. So when you divide your expenses based on that ratio, you're going to follow these rules. Any day that the unit is rented at a fair rental price is a day of rental use, even if you use the unit for personal purposes on that day. This rule does not apply when determining whether you use the unit as a home. Any day that the unit is available for rent but not actually rented is not a day of rental use. So the IRS has this worksheet. It's worksheet 5.1, worksheet for figuring rental deductions for a dwelling unit used as a home. It says use this worksheet only if you answer yes to all of the following questions. Did you use the dwelling unit as your home for the year? Did you rent the dwelling unit at a fair rental price 15 days or more during the year? Is the total of your rental expenses and depreciation more than your rental income? And if the answer is yes to all of those questions, then you're going to fill out the form. So it's not a form, it's a worksheet. So this form does not get submitted to the IRS. You use it to figure the amounts that you will enter on Schedule E, and then Schedule E is submitted to the IRS. So Part 1 says figure your rental use percentage, and you begin with the total days that it was available for rent at a fair rental price. And then you go the total days available for rent but not rented, total days of rental use, which is subtract B from A, total days of personal use, including days rented at less than a fair rental price, the total days of rental and personal use, and then the percentage of expenses allowed for rental. And essentially what the IRS says is if you had the rental property and it was available for rent 365 days during the year and you rented it 100 days and you occupied it for 20 days, then the total days of use is 120 days. And the rental would be 100 divided by 120 to get the rental portion. So allowable rental expenses. The next phase in Part 2 is to enter the rents that you received, and then you enter the rental portion of deductible home mortgage interest and qualified mortgage insurance premiums. You enter the rental portion of real estate taxes and the rental portion of deductible casualty losses. And you also enter any fully deductible rental expenses you had. Fully deductible rental expenses are expenses you had only because of the rental activity and not expenses that are part of the dwelling unit as a whole. Part of the dwelling expenses as a whole would be, say, utilities. IRS says those belong under another section. And you do all of that to figure up the allowable expenses. IRS says all of the expenses you figure in here are going to be allowed, even if they cause you to have a loss. But then we go on to other types of expenses that are not part of the fully deductible expenses, things like utilities, maybe homeowners association dues, and so forth. Those types of expenses are only going to be allowed to the extent that you show a profit. If there's personal use of a dwelling unit, you're not going to be allowed to claim a loss. And any of the expenses that put you into a loss essentially are going to break you even, and then the excess expenses are going to carry forward to a future year. There's some extra instructions in the worksheet here about the type of interpretation you should make about the amount that you would put on the mortgage insurance line, for example. These instructions are right here. I'm not going to read them all to you, but I'm going to read line 2A. It says figure mortgage interest on the dwelling unit that you could deduct on Schedule A as if you were itemizing your deductions if you had not rented the unit. Do not include interest on a loan that did not benefit the dwelling unit. For example, do not include interest on a home equity loan used to pay off credit cards or other personal loans, buy a car, or pay college tuition. Include interest on a loan that was used to buy, build, or improve the dwelling unit or to refinance such a loan. So this may be a question you've been asking yourself. Okay, well, I have a home here that has a mortgage on it, and the owner of the home took out a second and used that second to pay college costs. How much mortgage interest am I really allowed to deduct on the Schedule E? And the IRS is saying only the portion of the mortgage interest that's attributable to the dwelling itself and not used for other purposes, like buying a car. And then let's move down to an illustration of how the formula and that worksheet are going to be utilized to figure the amount of expense to enter on a tax return. And in this case, our character is named Nemo Clown, and he owns the beach vacation rental in Hawaii. Nemo rented the property at its fair market value for $150 per night for 200 days during the year and received total rents of $30,000 for the year. He used the property for personal purposes 25 days during the year, and the property was available for rent but not rented the remaining 140 days of the year. Using the IRS allocation formula, Nemo is allowed to claim all direct expenses on Schedule E. He is also allowed to deduct a portion of his indirect expenses using the following formula. 200 days of rental use divided by 225 days of total use gives us 88.89%. And Nemo had the following expenses for the property. So the total expense is listed here in the total column. Mortgage interest was $20,000, real estate taxes $5,000, advertising $1,000, professional fees $200, cleaning and maintenance $3,000, utilities $1,000, and insurance $2,500. And we're going to use that ratio of 88.89% to figure the amount that's going to be allowed on the Schedule E. And the fully deductible amount on Schedule E is going to be 88.89% of the mortgage interest, similar percentage on the real estate taxes, but the advertising and the professional fees are directly allocable to the rental unit itself, and so they're deducted in full and they're not multiplied by the percentage. We then have these cleaning and maintenance, utility, insurance expenses. Those are allocable to the dwelling unit, and they're shared between personal use and rental use, and so we're going to multiply those amounts by 88.89%. When we add all of them up, we get $5,778. Personal use is going to be the difference between total use and rental use, and that gives us 11.11%. And so we have $2,222 of mortgage interest that will carry to Nemo's Schedule E, and $555 that will also carry to Schedule A. So $2,222 of mortgage interest to Schedule A, $555 to Schedule A, and the balancing amounts of those are going on the Schedule E. But these personal portion amounts that are for utilities, insurance, and maintenance, those are non-deductible personal expenses and cannot be deducted anywhere. So ultimately, when we're finished with all of these numbers, we've got amounts to carry to the Schedule E as follows. $17,778 of mortgage interest, $44.45 of tax, $1,000 of advertising, $200 for professional fees, cleaning and maintenance, utilities, and insurance, as you see here. So total rental expenses are $29,201, and he had $30,000 of revenue, so it's looking good right there. And then these are the amounts that he'll claim on Schedule A. Now we're not done, though. There's a little bit of extra information here. Depreciation for the rental portion of the business use of this property is $970, and that depreciation is not included in here. So you can see that when we add depreciation in, we're going to have a number that is greater than $30,000. And since Nemo occupied this property for more than 14 days during the year, he's not allowed to claim losses. So that means we know already that he's going to have a carry forward. But in addition to that, he already had a carry forward from the earlier year of $1,000. You can see here it says he has a carry forward of unallowed operating expenses from 2011 in the amount of $1,000. So his total rental expense for the year, including depreciation and carry forward, bumps up to $31,171. And we're going to complete his Schedule E, and the worksheet is shown next. So firstly, we go through the formula to figure out the business percentage use. And in the earlier worksheet up here, I'm going all the way back up to this line, we've got A, B, C, D, and E. If you fill those lines out, you ultimately get the ratio that is the starting point right here. So the worksheet I'm showing you doesn't have that formula in it. It figures the formula and starts with that number, percentage 88.89. Then on line 1, we enter the rents received. And on line 2, we enter all of the amounts that are fully deductible. We've got the fully deductible business portion of the mortgage interest, the fully deductible business portion of tax. We have the fully deductible advertising and the fully deductible legal. When we add all of that up, we get $23,423. And then we subtract that from the rental income, and we get $65.77. Now earlier, when we added up all of our other expenses, we came up with a number that is, we know, going to put us at a number that's less than total income for the year, but once we add in the depreciation and the carry forward, it's going to be too big a number. So ultimately, this 6577 number is important because our other indirect expenses cannot exceed this number for the year, and if they do exceed it, there's going to be a carry forward. So let's see what happens. We enter the rental portion of cleaning, insurance, utilities. We also enter the carry forward amount from the earlier year of $1,000. And when we add all of that up, we get $67.78. Too high a number, it's not going to be allowed. We're going to have to go with the lower number on line 3. So we carry line 3 down to line 4C and enter it. And then on line 5 and 6, line 5 is a 0. That's the amount of profit that we have for the year, or loss for the year. It's a 0 either way. And then we have the rental portion of depreciation of $970. And ultimately, if we take the difference between these two numbers, we get 201. And that's going to be the carry forward of operating expenses, and then we're going to also have a carry forward of the 970 to the future year. So let's look at the Schedule E for NEMO. We enter the type of property it is, which is a vacation property. Code 3 indicates that it is a vacation property. And then the fair rental days are 200, and the personal use days are 25. On line 3, we enter the rental income, which is $30,000. On line 5, we enter the advertising in full. On line 7, we enter the prorated cleaning and maintenance. We enter the prorated insurance. We enter the legal expenses in full. We enter the prorated mortgage interest. We enter the prorated property taxes, and then the utilities prorated. Then on line 19, it says list other expenses. And although the operating expense carryover from 2011 is $1,000, we're only going to be able to enter $799 because $201 is being disallowed and is carrying forward again to 2013. So the net effect of all of that is to cause the total expenses on line 20 to be exactly $30,000. So the net profit is 0. This form then asks us to enter the total income, which was $30, the total mortgage interest, which is $17,778, and all other amounts reported as expense, or all the total amounts of expense are $30,000. So that is how the IRS says we should prepare NEMO's return when there is personal use of a dwelling unit. Now, Drake software, which is the software I use, has a checkbox in it where you can elect to use the tax court method. You may have noticed that in your software as well, or maybe your software doesn't offer it. So you might scratch yourself on the head and say, what is the tax court method? So I figured I should include some information in our course today about what the tax court method is, and here it is. Although IRS instructions for the allocation of mortgage interest and real estate taxes between personal use and rental use of a dwelling unit are based upon the ratio of fair rental days of use divided by the total days used, tax courts have held that these expenses should in fact be applied based on a ratio of total fair rental days divided by the total days in the year. Differences in how tax courts have interpreted allocation of expenses as compared with IRS interpretation pertains only to the determination of the rental portion of mortgage interest and property taxes claimed on Schedule E and not to other expenses paid to maintain the dwelling. So what I mean by that is if we go back up to this schedule here, the mortgage interest, according to IRS, should be allocated based on this formula to give us 88.89%. And so should all of these other indirect expenses. IRS and tax court differ in that the tax court says, although you would apply 88.89% to these indirect expenses, the mortgage interest and real estate taxes, you're going to look at the total days of rental of use versus the days that were rented at a fair market value. So in our formula, we have 365 days in a year. And you could say that the property was rented 200 out of 365 days. That's going to give you a much smaller ratio than to say that the property was used for 225 days, 200 of which were rental days. So you can see that the IRS ratio gives you a higher percentage than the tax court ratio. And is that a good thing or a bad thing? What are you supposed to do with it? So what are the differences, the key differences? So differences in how tax courts have interpreted allocation of expenses as compared with the IRS's determination pertain only to the real estate taxes and mortgage interest, and obviously casualty losses as well. And what happens is that the IRS method causes a higher percentage of these expenses to be claimed on Schedule E, thereby causing the allowable amount of other operating expenses of the dwelling to be limited. So we saw with Nemo, using the IRS method, that he has $201 of operating expense carry forward that he can't claim, and he has $970 of depreciation he can't claim because his mortgage interest and real estate taxes were claimed at a rate of 88.89%, and they just used up too much of his profit or his income. The tax court method would reduce the amount of real estate tax and mortgage interest that is claimed on Schedule E and push more of it over to Schedule A. So if you push more of it over to Schedule A, you would in fact increase the profit on Schedule E, and you would allow the remaining $201 of carry forward from 2011, plus you'd allow all of the $970 of depreciation to be claimed. And if he's then still able to claim mortgage interest and real estate taxes on Schedule A, he might come out ahead in that formula. Or maybe not. It could go either way. It just depends on how the numbers are working out, what other deductions he has. But by reducing the amount of mortgage interest and real estate tax expense claimed on Schedule E, the tax court method allows for greater deductions of other expenses that are directly related to the dwelling. The tax court method was established back in 1982 in a case called Bolton versus the Commissioner of the IRS. And this is one particular link I was able to find on the internet. If you click on it, you could go read the summary of that particular ruling. I've also found a couple of other professional articles that you could read on the topic. One is the July 7, 2007 issue of the CPA Journal that was published by the New York Society of CPAs. They have a good summary of the rules and their opinion on it. And another one is the Duke Law Journal, which also gives its opinion on the tax court method. Now, I have also read some blogs on the internet that people are saying, whatever you do, don't do the tax court method. You have to live in a particular circuit court district in order to use it. Ninth Court District is one of the ones I've heard about. People are concerned if you don't live in one of the districts where the tax court ruling occurred, that the IRS won't honor the tax court method, and so it's risky to claim it. But if you do live in one of those districts, you can claim it. I'm not a legal expert. I can't give an opinion on any of that. I would surmise that if the IRS has lost one or two times in court on this issue, that they have thin ground to stand on, but how an IRS auditor would approach it, I can't say. I have no experience in that. So you're going to have to make a judgment call with your client about which method to use, but one of the things I would not recommend you do is flip your method back and forth year to year. You're going to take a method and stick with it. All right, so what are some possible negative aspects of selecting the tax court method? You kind of can hint there that might be a good reason to do it because it might allow you to claim more expenses, but are there any negative aspects to doing that? Well, in choosing the tax court method over the IRS method, you do run the risk of challenge by the IRS. I've never heard of it happening, but it could happen. You should also consider whether the vacation rental is a qualifying second home. Only interest paid on a qualifying first or second home mortgage is deductible on Schedule A. Thus, if it is established that a vacation rental is not a qualifying second home, then the personal use portion of a mortgage interest would not be deductible on either Schedule A or E. And here is an illustration of how the tax court method would allocate expenses, and it's the same exact situation as before with Nemo Clown, except we're going to do Nemo Clown Schedule E this time using the tax court method. So under the tax court method, Nemo's expenses for mortgage interest and real estate taxes will be calculated in this way. We're going to look at 200 fair rental days during the year divided by 365 days in the year, and when we do that, we get 54.79%. That 54.79% applies only to the mortgage interest, though, and not to the other expenses, which are still based on the 88.89% ratio. So when we do that, we end up with mortgage expense on the real estate taxes and the mortgage interest. We have $10,958 that would carry to Schedule E and $2,740 that would carry to Schedule E, and all of these other numbers are the same as they were earlier. And on the Schedule A, we now have $9,072 of mortgage interest claim going to Schedule A and $2,260 going to Schedule A. So our total itemized deductions on Schedule A are going to bump up to $11,332, and our total amount carrying to Schedule E is going to plummet from $31,000 something down to $20,638. So we come over to the tax court method. We've got the same worksheet you saw earlier. We're going to see that the tax court percentage is showing here. It doesn't tell you what the percentage is, but it's carrying the percentage amount over to line 2A and 2B. But all of the other numbers on the form are the same, with the exception of these calculations that we're doing here. And ultimately what happens is we end up being allowed to claim all of the operational expenses, including the carry forward, plus we're allowed to claim all of the depreciation expense. Going over to the Schedule E, this time we see we end up with a net profit of $7,354. So in Nemo's case, it's hard to say. We'd have to do his entire tax return, figure his tax, and decide whether the tax court benefits him more than the IRS method. He'd be touch and go. But there's plenty of situations where I could see it could be the other way. Now, I don't have a lot of clients with vacation rentals, but the one client that I do regularly work with who does have a vacation rental, she makes good money on that rental. They're usually in desirable locations, and they're able to successfully rent them out for a pretty good amount of money. You saw Nemo bringing in $30,000 for the year. My client does something similar with a ski lodge in the Mount Hood area here of Oregon. So vacation rentals can be a good little profit thing, but the IRS does scrutinize those quite closely, and it is wanting you to apply those formulas for days of personal use and days of rental use. Next topic we're going to look at is the rental of personal property. Everything we've been talking about has to do with rental of real estate. So if you were wondering what about rental of personal property, I've got a little note in here on that. You do not use Schedule E to report income from renting personal property. If you received income from renting personal property, such as cars, boats, tools, etc., report this income as follows. The rental activity involves the regular rental of property for a profit, then you report income from the rent of personal property on Schedule C or CEZ. So let's just suppose your business is renting tools. You have a shop, you've got a bunch of tools in it, people come in and rent those tools from you. That's going to go on Schedule C. It is not a Schedule E item. The rental activity is not regular or profit-oriented. IRS says report the income on Form 1040, line 21, and then report expenses related to the property on line 36 of 1040, and then write PPR for personal property rental and the amount of expense on the dotted line next to line 36. Well, I have horses, and so I always like to think of horses as an example or an illustration to come up with. I have a horse trailer today, but there was a period of time where I had horses and no trailer to pull them in, and so I would enviously eye the horse trailer of other people, and if I needed a horse trailer, maybe try and figure out whether they would rent me their trailer. Never came to it. I never did ask the question, but I used to think about it. What would have happened if I had rented their trailer, you know, say for a 2-week trip or something, borrowed their or rented their trailer? They're not in the business of renting personal property, would it? That would just be that someone they know, an associate, has come and said, hey, I'd like to rent your personal property from you. Here's some money. And what are you supposed to do with that money? Well, IRS says you report it as other income on line 21 of your Form 1040, and you would call it personal property rental. Now, are you allowed to deduct any expenses? Well, if you could come up with some expenses to claim against that rental property, then you would enter the expenses directly on line 36 as an adjustment to income, and you write PPR for personal property rental expenses. All right. I see a whole bunch of chats coming up here. Extreme Home Makeover rents the property for less than 14 days, and all the rent is not taxable to the homeowner. That would be correct, according to what IRS is saying. The situations where homes get rented for high dollar values for less than 15 days is not common. But it is possible, and that Extreme Home Makeover could be one, and in my client's case it was a catalog company renting his home. So I have a timeshare that I rent out, and the fair rental days are only 7 days, and I have no personal use. Would I report that on Schedule E? Well, if you have a timeshare and you don't occupy it at all, then you have no personal use, and the entire thing does go on Schedule E. So the whole formula I gave you is when there is personal use of a dwelling unit during the year. If you own a dwelling unit that you could use for personal use, but you never did use it for personal use, and it was either vacant or rented out the whole year, then there is no proration that goes on, and you enter all of the income and all of the expenses on Schedule E. And then since car washes are considered leasing personal property, would these still be reported on Schedule C and not E? Car washes? Are you talking about you go up and you go through a car wash? That's definitely a business. It's not a rental. Arizona sees a car wash as the renting or leasing of personal property. Is that like those coin-operated ones? Like a coin laundromat as well? I see that as a Schedule C item, not a Schedule E item anyway, because it's personal property. If it's personal property rental and you're doing it for a profit, it goes on Schedule C. It doesn't go on Schedule E. That's the bottom line. You've got a house, it's a vacation property, and you didn't use it even one day during the year, but you rented it for 14 days during the year. Well, you're getting into a scenario there about whether or not this is, in fact, a for-profit, money-making enterprise that is supposed to be a Schedule E activity, or whether or not this is really a second home, a vacation home. And if it is a second home or a vacation home and you rent it for fewer than 15 days during the year, you don't report the income. You could get into some discussions about whether or not you can claim a deduction on Schedule A, because IRS says you are allowed to deduct on Schedule A mortgage interest that you pay on your first and your second home. And if you can say that this vacation property is your second home, then you can deduct it. Now, are they going to get into whether or not it really is a second home because you never occupied it? I would suppose it would just depend on how long you go without occupying it and the reasons why you are not occupying it, kind of beyond the scope of today's class. All right, so we're finally at a point, as I promised, we would be getting onto the at-risk rules. So let's take a look now at the next topic of the day, which is at-risk rules. And I would say in my work as a tax supervisor, or tax preparer supervisor, overseeing the work of other people and also reviewing the work on tax returns that I see done by other professionals out there, application of the at-risk rules seems to be a concept that escapes a lot of people. It escapes the tax client, understandably, but it also escapes many tax professionals who simply don't get it and they don't apply the rules. So we're going to talk about the at-risk rules. And I'm just going to bring to case in point in an illustration. When your client comes to you with a K1, say from a partnership, and that K1 on line 1 shows a negative number, say a loss of $20,000. The question you need to be asking yourself is that loss allowable? Can I take negative $20,000 from that K1 and put it on line 17 of my client's tax return, and can they claim that negative $20,000 loss? Well, many, many years ago, I saw a tax return prepared by a woman, and I was then reviewing her work. And I saw that she had allowed something in the amount of $20,000 of a loss to be claimed on a particular tax return. Well, I knew enough about the scenario to know that none of that $20,000 loss was allowable because the client was not at risk for any of it. So when you're a partner in a partnership, you can have one partner who puts all of the money in. And that partner is the one that is at risk for all of the money going into that partnership. And you could have other partners who are contributing their time and their energy but have no money at risk. So it's possible to get a K1 showing a loss that you're not allowed to claim. And in order to determine whether or not your client can claim that loss, we have to apply the at-risk rules. And that's what we're covering now. If your rental property or any other business activity you are involved in results in a net loss for the year, you may use the loss to offset other income only if you are at risk for the money lost in the activity. You are considered to be at risk to the extent you have after-tax amounts invested that have not already previously been deducted. Figuring your allowable loss. Generally, you must complete Form 6198 to figure your allowable loss if all of the following is true. You have a loss from an activity carried on as a trade or business or for the production of income, and there are amounts in the activity for which you are not at risk. You must apply the at-risk rules before you apply the passive activity rules that are discussed next in this course. And that's why I'm covering at-risk first. Amounts at risk. The amount considered to be at risk includes the amount of money that you contributed to the activity, the adjusted basis of property you contributed to the activity, and the amounts borrowed by you and contributed to the activity. For amounts borrowed, to be considered to be at risk for an amount borrowed, you must be personally liable for repaying the loan or have offered property as collateral for the loan. If you offered property as collateral, you are at risk for the fair market value of your interest in the property. Property offered as collateral for a loan cannot be used in the activity. Amounts not at risk. You are not considered to be at risk in an activity to the extent you used non-recourse loans to finance the property. There is an exception for non-recourse financing. If amounts contributed to or pledged to an activity are protected against stop-loss agreements, guarantees, etc. So you could have contributed $10,000 to an activity, but there's a stop-loss agreement that says if the activity loses money, we're going to guarantee you get repaid no matter what. And if that's the case, you're not at risk. And number 3, for amounts borrowed for use in the activity that come from a person who is not a creditor but holds an interest in the activity. So let's just suppose a fellow partner or shareholder in the activity contributes $20,000 for you and basically loans you the money and contributes to the activity on your behalf. If they're a partner in the activity, you're not at risk for that. They technically are, is what the IRS is saying. Now there is a section for qualified non-recourse financing, and we're going to get into amounts that are not at risk. So for amounts that you borrowed for use in the activity that come from a person who is not a creditor but holds an interest in the activity, and note a shareholder's interest in a corporation is not an interest in an activity of the corporation under this rule, and then we're going on to non-recourse financing. Qualified non-recourse financing is financing for which no one is personally liable for repayment and is borrowed by you to hold real property, secured by real property used in the activity, and not convertible from debt obligation to ownership interest, and an amount loaned or guaranteed by any federal, state, or local government or borrowed by you from a qualified person. A qualified person is a person who actively and regularly engages in the business of lending money, such as a bank or savings and loan association. A qualifying person cannot be related to you unless the non-recourse financing obtained is commercially reasonable and on the same terms as loans involving unrelated persons. The seller of the property, or a person related to the seller, or a person who receives a fee due to your investment in real property, or a person related to that person. Adjustments to at-risk basis. The following adjustment items will affect your at-risk basis. Your basis increases if you contributed additional cash or property to the activity, or you assumed additional qualified liabilities. You received a share of taxable or non-taxable income from a pass-through entity, such as a partnership or S corporation. Profits of pass-through entities are passed through to partners and shareholders on Form Schedule K1, and your share of income from these activities adds to your basis. So you've got a client's K1, and it shows on line 1 that there was a profit of $10,000 for the year. When you're doing basis calculations for that partner, you would add $10,000 to their basis in the partnership. Or if you guarantee a loan from the partnership in which you hold an interest, that can increase your basis. But I wanted to kind of make a caveat here. Note that a partner who guarantees a loan taken out by a partnership will increase the at-risk amount in the partnership. However, this rule applies only to partnership interest and not to S corporation interest. IRS rules specifically state that shareholders who guarantee loans taken out by an S corporation do not increase their at-risk amount in the corporation. And here is an example of additions to basis. Rhett purchased a rental property for $150,000. He made a $50,000 down payment and used qualified non-recourse financing for the remaining $100,000 of the purchase price. Rhett also has a second mortgage on the rental property in the amount of $10,000, which he used to put new siding on the property. Rhett's at-risk basis in the property is the sum total of all of those amounts, $160,000. Here's another continuing example. Flow-through income from S corporation adds to basis. Rhett is a 30% shareholder in the S corporation, Terra Inc. His 2011 year-end basis in the corporation was $20,000. In 2012, he received a K-1 reporting income of $10,000. Rhett took no distributions from the corporation during the year. Therefore, his at-risk amount as of the end of 2012 has increased to $30,000. Now your basis will decrease if any of the following occurs. You received a distribution of cash or property from the activity. You were relieved of a liability relating to the activity, or a recourse debt relating to the activity was converted to a non-recourse debt, or you shared in losses flowing through to you from your ownership interest in a pass-through entity such as a partnership or S corporation. And here's an illustration. Relief of liability decreases basis. Rhett owns a rental property with a basis of $160,000 figured as follows. His cash down payment, his qualified non-recourse first mortgage financing, and his qualified non-recourse second mortgage financing. Total amount at risk, $160,000. Due to a decline in the housing market, the bank holding the second mortgage decided to cancel $2,000 of the outstanding $10,000 mortgage. Rhett's year-end at-risk amount in the rental property is reduced to $158,000. I actually had that happen with a client a couple of years ago when the housing market took that big slide. He had a house with a big second mortgage on it. he was at no risk of defaulting, had great credit, good income, but the bank, Wells Fargo, sent him a letter saying, we're willing to cancel $30,000 of this second line of mortgage. And my client came to me and said, is there any reason why I shouldn't do that? And it was like, heck no. Go ahead and take it. And it's treated as a reduction in basis. Illustration, distribution from S corporation reduces basis. Assume the same facts as earlier regarding Rhett's ownership and interest in the S corporation Terra Inc., except that during the year he took a $5,000 profit-sharing distribution from the corporation. You'll figure his year-end basis amount as follows. You'll take the 2011 year-end basis amount of $20,000. You'll add to that the 2012 K1 income of $10,000, and then you'll subtract out the 2012 distributions. So the at-risk amount as of the end of the year would be $25,000. Recapture rule, at-risk amount or at-risk basis is less than 0. If your at-risk amount in any activity is less than 0, you may be required to recapture previously allowed losses. The recapture amount is the lesser of the negative at-risk amount or the total amount of losses you deducted in earlier years minus any of the amounts previously recaptured. Activities covered by the at-risk rules. You are subject to the at-risk rules if you were involved in any of the following activities as a trade or business for the production of income, including holding, producing, or distributing motion picture films or videotapes, farming, leasing Section 1245 property, that's personal property, exploring or exploiting oil and gas, exploring for or exploiting geothermal deposits, or any other activity not included in items 1 through 5 that is carried on as a trade or business or for the production of income. Examples of other activities carried on as a trade or business for the production of income include ownership of a sole proprietorship business, filing Schedule C, ownership of an interest in a partnership activity that owns a rental property, or ownership interest in an S corporation. All of those are business activities that are affected by the at-risk rules. Form 6198 is the form that you use to figure your at-risk limitation and to apply the at-risk limits if they apply. The form is filed by individuals, estates, trusts, and certain closely held C corporations. You need to file Form 6198 if a partnership or S corporation in which you have an interest incurred a loss for the tax year and you had any amounts in the activity for which you were not at risk. On Form 6198, you use Part 1 to figure your current year profit or loss from an at-risk activity. You use Part 2 or Part 3 to figure your at-risk amount for the year, and then you use Part 4 to figure your deductible loss for the year. And so here is Form 6198 itself. I've divided it into the parts that you see into these colored sections. Part 1 is used to report the current year profit or loss from the activity and to report losses or deductions from earlier years that you could not deduct because the at-risk rules limited or did not allow you to claim the loss. Part 2 is used if you know your adjusted basis in a partnership or S corporation, and you use Part 3 as a longer method of figuring your at-risk amount. It can produce a larger at-risk amount than Part 2, so if you complete Part 3, you do not also complete Part 2. And then finally, down in Part 4, use Part 4 to figure your deductible loss for the year. If the loss on line 5 is equal to or less than the amount on line 20, report in Part 1 in full on your tax return, or the amount in Part 1 in full on your return, subject to any other limits, such as the passive activity loss limits and the capital loss limits. So would you like to see an illustration of how that would come together? It's a lot of words to describe what you need to do, and ultimately when you get the K1 staring at you, this is where you need to apply the at-risk limits and fill out a 6198 and make it all come together. In our illustration, we have Matt Dillon. He owns 50% of the S Corporation Gunsmoke, Inc., in which he is an active participant. Matt's basis in Gunsmoke at the beginning of the year was $20,000, and during the year he contributed another $15,000 to the corporation. Matt is also a guarantor for a $100,000 loan Gunsmoke currently has with First County Bank. Matt's K1 from Gunsmoke, Inc. is shown below. Prepare his 6198. So we can see right here that the business has incurred a loss of $50,000. That's his distributive share of the loss, his half of the loss. Normally a K1 would have a lot of other numbers on it, but we're just stuck here on line 1, and we're going to give you that number and move on. Matt's allowable losses from Gunsmoke cannot exceed his basis, and even though he is a guarantor of the loan that Gunsmoke has with First County Bank, IRS rules state that Matt is not at risk for that loan directly and cannot increase his basis in Gunsmoke by the amount that he is guaranteeing. Matt cannot claim a larger loss on his 1040 than he is at risk for. His loss on Form 6198 is limited to the amount he has invested. So we begin Form 6198 by entering the loss for the year, $50,000. Then on line 6 in Part 2, we enter his adjusted basis at the beginning of the year, $20,000. On line 7, we enter any capital contributions he made for the year. That was $15,000. And we add those amounts up and we get $35,000. That's his at-risk amount. If the loss is $50,000, he's going to be allowed to claim $35,000 as a loss on his 1040. And so he will enter $35,000 and carry that over to line 17 of his Form 1040, assuming the passive activity loss limit rules are not applying. But we know from the description of the problem that he's an active participant, so they don't apply. But we're not done. We do need to complete Schedule E, page 2 for Matt. I did promise that we would eventually get to that, and we're at a point now where we're going to take a little bit of a look at Schedule E, page 2, not as closely as we did page 1, but enough to point out the key things you need to know about it. On page 2, we start in Part 2 here, where it says income or loss from partnerships and S corporations. We enter the name of the S corporation, Gunsmoke, and then in column B we enter a code S to indicate that it is an S corporation, and then we show check mark in box C. It says check if any amount is not at risk. Well, $15,000 is not at risk of the 50, so we are checking that box. We then go over to column H, and in column H we enter a non-passive loss from Schedule K1 of $35,000, and we ultimately end up carrying that to the bottom of the form, entering it on line 41, and then moving it over onto line 17 of Matt's 1040 return. So that's how the at-risk limits affect us. Now let's move on to passive activity loss limits. So we're going to spend the last hour of today's class looking at passive activity loss limits, and we're also going to take a look at the classwork assignment at the end of class. Middle Earth, M-I-D-D-L-E-E-A-R-T-H, Middle Earth. You can see I have a couple of poll questions up there on the board for you, and there were also a couple of questions that came in from attendees. One of the questions was, please provide examples of when borrowing is considered to be qualified non-recourse financing. And it's kind of a good topic because one of the poll questions I have up has to do with qualified non-recourse financing. And essentially, qualified non-recourse financing is a situation where you have a property that is mortgaged, and the lender who is mortgaging that property is in the business of lending money. That's what they do as a trade or business. And their only collateral or security for the loan is the property itself, so that if you default on the property, they can possess the property, take it away from you, but they cannot go after you personally beyond that. That would be qualified non-recourse financing. So with that definition in mind, let's go over and look at C question number 4 that I have up here on the left side of the screen. It says, Bill took out a $100,000 non-recourse loan and bought an apartment building. The building is not security for the loan. Bill spent $25,000 of his own money on repairs before he rented the apartment building to the public. Bill is single, works full-time, and earns $80,000 a year. His loss from the rental real estate activity in which he actively participates is $30,000. He has no passive income. For what amount is Bill at risk, and how much of Bill's passive loss from his rental activity is deductible? The correct answer is B, and let's see why. Even though the price of the property was $100,000, it's purchased with non-qualifying, non-recourse debt. So Bill is not at risk for the $100,000. The second issue we look at is how much other money did he put into the activity. He put in $25,000 into the activity, so he is at risk for the $25,000. And then we look at the total loss from the activity, which is $30,000. Well, $30,000 is the loss, but he's not at risk for that loss. So ultimately, the loss that he is at risk for and the passive loss that he's allowed to claim are both answer B, which is $25,000. Now, in a little bit, we're going to get into the rules that when a passive activity loss like this is deductible, and I can tell you that based on his income, Bill's income is low enough that he would qualify to claim the loss, and that's why B is the correct answer. Let's take a look at the next question here. John offers his beach cottage for rent from June through August 31, which is 92 days. His family uses the cottage during the last 2 weeks in May for 15 days. He was unable to find a renter for the first week of August, which is 7 days, and the person who rented the cottage for July allowed him to use it over a weekend, 2 days, without any reduction or refund of rent. The cottage was not used at all before May 16 or after August 31st. Total income was $11,000 and total expenses were $4,000. What percentage of the expenses for the cottage can John deduct as rental expenses? And we're assuming that these expenses are not mortgage interest or real estate taxes. We're just going to look at the ratio. And the way the ratio is going to work is we're going to take the total days at fair rental income plus the total days of personal use, and we're going to add those together. And so the first thing that we're looking at that you have to think about a little bit is he offered his cottage for rent for 92 days, but there were 7 days when it wasn't rented. So you're going to subtract 7 from 92. And when you do that, you get some math going on. So 92 minus 7. And then you're going to add in the total days of personal use. Also in here is 2 days where they occupy it, but it's still rented at fair rental value. And so whenever you occupy rental property, during a period of time you have also received rent for that property that is fair rent, then that is not counted as a day of personal use, but rather a day of rental use. We're essentially going to take 92 minus 7 plus 15 to get the total days of use. And then we take 92 minus 7 and divide that by the total days of use. And when we do that, we get 85%. So 5C, 85% is the correct answer. And I did have a pod here that I put together with notes on the answer. Note number 5 has the description, so let's read it together. It says, when dividing expenses, follow these rules. Any day that the unit is rented at a fair rental price is a day of rental use, even if you use the unit for personal purposes on that day. And there were 2 days like that. Any day that the unit is available for rent but not actually rented is not a day of rental use. In this case, the rental was available for rent 92 days, but was only rented for 85 days. That's 92 minus 7. The rental was used for personal purposes 15 days while it was not being rented, which results in a total of 100 days of use. The percentage of time that the cottage was used as a rental is 85%, and that is why the correct answer is C. All right, so the next topic is passive activity loss limits. And at risk is a little bit more straightforward, I think, to understand than passive activity loss rules. There's more rules and more exceptions to rules when we're dealing with passive activities than there is with at risk. I would say the complicating factor of at risk is just actually figuring out how much money they do have at risk. If the records are shabby, that's really hard to establish. But if the records are good and proper records have been maintained over time and all the ins and outs have been tracked, you pretty much should be able to figure the at-risk amount. Passive activity, let's talk about it now. Rental real estate activities are generally considered to be passive activities, and the amount of loss you can deduct is limited. Generally, you can only deduct passive activity losses to the extent that you have income from other passive activities. Let's look at a historical perspective, because I always like how history plays in. Prior to 1986, a taxpayer could generally deduct losses in full from rental activities and trades or businesses regardless of his or her participation. This gave rise to significant numbers of tax shelters, many of them abusive, which allowed taxpayers to deduct non-economic losses against wages and investment income, thereby reducing or eliminating any tax. The Tax Reform Act of 1986 added IRC Section 469, and this section limits a taxpayer's ability to deduct losses from businesses in which he or she does not materially participate and from rental activities. For real estate professionals, beginning in 1994, a relief provision was introduced relating to rental real estate for taxpayers who are rental real estate professionals and spend most of their time in real property trades or businesses. This provision allows certain taxpayers to deduct current losses from rental real estate activities in full without any passive loss limitation. Scope of rules. The passive activity loss rules are generally applied at the individual level. Although Internal Revenue Code Section 469 was enacted to discourage abusive tax shelters, its impact extends far beyond shelters to virtually every business or rental activity, whether it is reported on Schedule C, F, or E, as well as to flow-through income and losses from partnerships, S corporations, and trusts. Generally, the law does not apply to regular C corporations, although it does have a limited application to closely held corporations. Note that the paragraph above that I just read you references an Internal Revenue Code section, and you can read the section in full if you wish to by clicking on the link. And then you would get to a U.S. code search page, and then you could enter 26 in the title box if you really wanted to get into it. Categories of income and loss. The Internal Revenue Code divides all income into two categories, passive and non-passive. All income in the world, the IRS says, is one or the other, passive or non-passive. And passive includes rentals and businesses without material or participation. Non-passive includes businesses in which the taxpayer materially participates, but it also includes salaries, guaranteed payments, 1099 miscellaneous compensation, and portfolio or investment income are both deemed to be non-passive. You may have noticed that the IRS doesn't say passive and active. That would be too logical. They say passive and non-passive. So if you are not passive, then you are non-passive. So what is passive income? Passive income is income generated by a passive activity in the ordinary course of a business. And there are two kinds of passive activities: rentals, including both equipment and rental real estate, regardless of the level of participation, and businesses in which the taxpayer does not materially participate on a regular, continuous, and substantial basis. What is a non-passive activity? Income and losses from the following activities are generally considered to be non-passive: salaries and wages and 1099 miscellaneous commission income, guaranteed payments, royalties derived in the ordinary course of business, sole proprietorship or farm on which the taxpayer materially participates, partnerships, S corporations, and limited liability companies in which the taxpayer materially participates, trusts in which the fiduciary materially participates, pension or annuity income, and lottery or gambling winnings. Portfolio income is also called non-passive income, and portfolio or investment income is income typically reported on Schedules B or D, and portfolio income includes income from interest, dividends, capital gains, and losses, including gains or losses from stocks and bonds or the sale of undeveloped land or other investment property. So how do these limits work? Generally, losses generated by passive activities can only be used to offset income generated by other passive activities. There is an exception to this rule when there is a disposition of a taxpayer's entire interest in a passive activity. So what that's saying is you have a passive activity. Let's use a rental property here, for example, and because you don't meet any of the exceptions, you haven't been allowed to claim your losses. So you have accrued losses of $50,000 that have been carrying forward for some time. In the year you sell that activity and dispose of all of your interest in it, the IRS says you can claim those outstanding losses. Losses from passive activities cannot offset other income from non-passive activities. And other income includes wages, portfolio or investment income, or profit or income from any other form of non-passive activity that is a sole proprietorship, farm, partnership, etc. In other words, a taxpayer cannot deduct losses from passive business activities and rentals unless he or she reports other passive income on the tax return against which those losses can be offset. Here we have an example of how a loss from a passive activity is going to be limited. Luke is a 40% owner of Yemen Inc., which is an S corporation. The daily business activities of the corporation are carried out by employees of the corporation and by other shareholders. Luke's participation is limited to the money he has invested in the corporation. During the year, Yemen Inc. incurred a $25,000 operating loss. Luke's distributive share of the loss is $10,000. Luke will not be able to claim his loss on his personal return unless he has net passive income from another passive business or rental activity. If Luke has no other passive income, he has to carry the loss on Yemen Inc. forward each year until he either has income from that passive activity or another passive activity, or he disposes of his entire interest in Yemen Inc. Passive activity credits. You can subtract passive activity credits only from tax on net passive income. So that means you have to have taxable passive income. So let's just suppose you've got a rental property and you make an improvement to that property by putting in a wheelchair ramp. That wheelchair ramp qualifies you for disabled access credit. 50% of the cost of the ramp up to $1,000 or $2,000 is eligible for a credit. But you run the rental property at a loss, and so you're not allowed to claim the credit because you don't have any taxable income from any other passive activity as well. So you're looking to see that on the tax return, if you want to claim a credit for offsetting tax generated by a passive activity, it means you actually have to have positive income from a passive activity on which you are paying tax. And if that's the case, then if you qualify for a credit, like the disabled access credit, then you can use that credit to offset tax on that passive activity income. But if you were not able to claim a credit because the credit was only for passive activity and you have no passive activity income on which to claim the credit, then the IRS says when you sell that activity, the amount of credit you did not claim would be added back to the basis of that particular item. Exception for active participation in rental real estate activities. You may be able to deduct up to $25,000 of loss on your rental real estate if you actively participate in managing your rental real estate. Active participation is a lower standard of involvement than material participation. We're going to talk about both of those. If you meet the active participation test, you can deduct up to $25,000 or $12,500 if you are married filing separate and did not live with your spouse at any time during the year. You would be able to deduct that amount of loss. But if you are married filing separate and did live with your spouse during the year, you are not allowed to claim any loss at all. Now, the amount of your allowable passive activity loss for your rental real estate is reduced and gradually eliminated as your modified adjusted gross income rises between $100,000 and $150,000, half that amount if you are married filing separate and did not live with your spouse during the year. The $25,000 special allowance is phased out at a rate of essentially 50 cents for each dollar that your income exceeds $100,000. And if your filing status is married filing separate and you lived with your spouse, your allowable loss is 0. Modified adjusted gross income. For purposes of passive activity losses from rental real estate activities, your modified AGI is your AGI from line 38 of Form 1040, figured without taking into account any passive income or loss or any loss allowed by reason of the exception for real estate professionals, taxable Social Security or Tier 1 railroad retirement benefits, deductible contributions to an IRA or certain other qualified retirement plans, the deduction for employer equivalent portion of self-employment tax, the deduction allowed for student loan interest or tuition fees, the exclusion allowed for employer-provided adoption benefits, the exclusion allowed for qualified U.S. savings bond interest used to pay for qualified higher education, the deduction for domestic production activities, and finally, any overall loss from a publicly traded partnership. All of these amounts have to be factored into account when you are figuring your modified adjusted gross income. So what is active participation? To be an active participant, both of the following have to apply. You and your spouse owned at least 10% of the rental property, and you made management decisions in a significant and bona fide sense. Management decisions include approving new tenants, deciding on rental terms, approving expenditures, and similar decisions. And here is an illustration where we have a partially deductible loss from a person who actively participates in his rental activity. Red Buttons is a single filer and is not a real estate professional. His 2012 W-2 shows $120,000 of wages paid. It was his only income for the year aside from the rental property. His Schedule E is attached, and it shows he has $27,917 rental loss from an apartment building that he owns. Red actively participates in the management of the apartment building. His modified adjusted gross income is $120,000, so his passive loss will be limited. We're going to actually figure the amount of loss he's allowed to claim, and that amount is going to be $15,000, which means he's going to have a $12,917 carryover to 2013. So let's just figure out how we do that. Now, without filling out the back page of Schedule E, page 2, or doing any worksheets, I've mentally figured out what his limited loss is going to be. We start with his income for the year, $120,000. And we look at how far that puts him into that phase-out range. And the phase-out range runs from $100,000 to $150,000. So you could say he's 40% of his way into that range, because you would take 120 from 100 and you get 20. You put 20 into 50 and you've got 40%, right? So that means he's not allowed 40% of the maximum allowable deduction of $25,000. Or conversely, you could say he is allowed 60% of the maximum, and 60% of $25,000 is $15,000. But that's just a simple April way of doing it. Let's look at how it all figures out on his Schedule E. Firstly, we have red buttons. We've indicated that he did not have to issue any 1099s during the year. We have the rents received. We have a whole bunch of expenses here, and quite frankly, with this amount of expense, I might tend to think maybe he was required to issue a 1099, but we'll leave it at no for now. And then we go down and we show that we've got his loss, $27,917, but he's not allowed to claim that full loss. We have to complete Form 8582 to figure the amount of loss he's allowed to claim, and we're going to enter $15,000 on line 22 after we figure that amount. We move over to the 8582, and the first thing we do is we take a look at Part 1, Line 1. And Line 1 is used to report rental real estate activities with active participation. On line 1A, we enter activities that had net income. He didn't have net income from any activities. We move on to line B, activities with a net loss. That's where he enters his loss. We have no other amount on line 1C, so we carry $27,917 loss over to line 1D. We have no activities that fall into the category of lines 2 or 3. 2 is commercial revitalization deductions for rental real estate activities, and 3 is all other passive activities. He has no other passive activities. So we again just carry that $27,917 down. The instruction here for line 4 says, if line 1D is a loss, which it is, go to Part 2. So we go to Part 2 and we enter on line 5 the amount that is on line 4. We then take his $150,000, which is the top income amount where you are allowed to claim real estate losses. We subtract out his modified AGI, we get 30, and then IRS methodology is to take that 30 and multiply it by 50%, and you get to $15,000. So there's April way that says just look into how far the phase-out range you are, and that's the amount that you're going to be allowed to deduct. And IRS has this other formula that essentially gets you to the same place with a different formula. So finally, his allowable loss is $15,000, and he's going to enter that on his Form 1040. He also has a carry forward, and we can see that we're going to use worksheet number 6, which is a part of 8582, to figure his carry forward. We enter the total loss on column A. We enter the unallowed loss in column B. In column C, we show the allowed loss, which carries to the 1040, and the unallowed loss will, of course, carry forward to 2013. Now let's look at an exception for real estate professionals. A real estate professional is a person who owns and manages rental property, and they are deemed to have non-passive income from that rental activity if they meet the requirements for being a real estate professional. So a real estate professional who owns and manages rental property is deemed to have non-passive income from that rental property, and as such, the real estate professional meets the material participation rules, and his or her losses on rental activities are not limited by the rules relating to passive activity losses. For any portion of the year that you were a real estate professional, your losses from active management of your rental real estate are not passive activity losses. So who qualifies as a real estate professional? Well, you qualify as a real estate professional if both of the following requirements are met. Number 1, more than half of the personal services performed during the year in all trades or businesses for the year were performed in real property trades or businesses in which you materially participated, and you performed more than 750 hours of service during the year in real property trades or businesses in which you materially participated. This is an important definition, and it's one you should be aware of, because your computer, in all likelihood, is going to apply the limits on losses on rental properties unless you know enough to interpret a situation where they don't apply. And that means somewhere in your computer you're going to have to tell it that there is an exception to the limit because they were a real estate professional. And to know whether or not they qualify under the exception, you have to know the two rules and they qualify for both. Now, not that many years ago, our firm actually had a client in it who was insisting that he was a real estate professional because he performed more than 750 hours of service in his real estate activity during the year. The thing was, he had a full-time job at Nike. And you can't really work 40 or 50 hours a week at Nike and then spend more of your time at real estate. We just didn't believe that story. So he couldn't qualify, in our estimation, as a real estate professional because his main source of income and the majority of his time was spent in a non-real estate activity endeavor, much as he tried to convince us otherwise. Note that personal services performed as an employee do not count unless you own more than 5% of the employing company. So what is a real property trade or business? Well, your business is a real property trade or business if it does any of the following with real property: develops it or redevelops it, constructs it or reconstructs it, acquires, converts, rents or leases it, operates or manages it, or brokers it. Also, real estate professionals can make an election to treat all interests in all of their rental activities as if they were a single activity. if you were a real estate agent or a real estate professional, you can choose to treat multiple real estate interests as one activity. You can make this choice for any year you qualify as a real estate professional. Once you make the choice, the following rules apply. Number 1, the choice is binding for the tax year you make it and for any later year where you are a real estate professional. The choice will continue to apply to years where you are not a real estate professional. However, for any year you are not a real estate professional, the rental activity will be subject to the passive activity loss limits. Grouping is important because if the activities are separate, you must show material participation in each one. If the activities are grouped, you only need to show participation in all of the activities as a whole. So let's just suppose you own 10 rental properties and you are a real estate professional. One of the methodologies you could have for accounting would be to file a separate Schedule E for each property and to track your expenses separately for each property. There could be really good reasons for doing that, not the least of which is really actively managing the profitability of each property and, being able to see how one stands out as being really profitable and maybe how another one stands out as really being a loss and helping you identify the reasons. But if you're a real estate professional, the IRS says you don't have to separate them all out. You could have a single P&L that lumps all of the numbers for all of the activities together and enter one column on your Schedule E and not 10 columns. Now, if you want to make the election to treat all rental properties as one activity, you need to attach a statement to your return. And the statement would read, I elect Section 469C7A, and this statement must be attached to your return in order for the election to be properly made acceptable to the IRS. And here is an illustration where the real estate professional losses are not limited. Real estate professional owns and operates a residential rental apartment. His income from the activity was $100,000 and his expenses totaled $129,180 for the year, leaving him with a $29,180 loss. Since he is a real estate professional, his loss is not limited by his income, nor is his loss limited to just $25,000. So we go over to the Schedule E. Down at the bottom, we total up all of his expenses, and we end up with a loss of $29,180, and that loss is allowed in full. But we do have to go over to Schedule E, page 2, and there's a line entry that we make on Schedule E, page 2, and we enter that on line 41. And then on line 43, it says reconciliation for real estate professionals. If you were a real estate professional, enter the net income or loss you reported anywhere on Form 1040 for all real estate activities in which you materially participated under the passive activity loss rules. So you would need to have an entry there as well. So what is material participation? Generally, a passive activity is any rental activity or any business activity in which the taxpayer does not materially participate. By comparison, non-passive activities are businesses in which the taxpayer works on a regular, continuous, and substantial basis. In addition, passive income does not include salaries, portfolio, or investment income. A trade or business activity is not a passive activity if you materially participated in the activity. The Internal Revenue Code defines material participation as regular, continuous, and substantial participation by a taxpayer. And determining whether an activity is passive or non-passive is done on an activity-by-activity basis and at the 1040 level. A taxpayer is generally deemed to be materially participating if he or she works more than 500 hours in a year at the activity or performs substantially all of the work in a business. If you materially participate in an activity, the activity is not passive and the losses are not limited. Conversely, if a taxpayer works 500 hours or less during the year or does not perform most of the work, losses are not allowable unless he or she has passive income. So last tax season, we're talking 2012, I had a new client come to me. He came to me because he had recently been through an audit with the IRS and he had some concerns about how that had gone. He had been self-preparing his tax return. And he had completed a Schedule C for himself for renting out a yacht. Not a huge yacht, a smaller yacht. And he parks it up in, I think, the Bellingham area of Washington. So I live in Portland, and he was driving up to the Bellingham area on weekends to take care of this yacht. And then he had a company that manages the wharf there taking care of collecting rents for leasing that yacht out. But he would go up, on the weekends and work on maintaining that yacht. Probably went out on it a little bit too. But anyway, he had this big Schedule C loss. So comes the auditor. And he goes downtown and meets with the auditor. And one of the very first questions the auditor started asking him about this property, this boat, and his activity with relation to it, was how many hours in the year he devoted to taking care of that boat and working on the boat. And he had no clue. He hadn't tracked the number of hours, and he had no idea why he was being asked the question. So he pulled a number out of his hat, 300 hours. And the auditor said, sorry, loss is not allowed. You owe XYZ dollars. So it was after that, after he'd been assessed the tax, I can't remember if he paid it or not, whether he was outstanding on that tax or not. Somehow he ended up in front of me. And I said, well, the reason they were asking you the number of hours was because if you participate in the activity 500 hours or more, then your losses would have been allowed. And he said, well, she never said that to me. And I said, well, it's not the auditor's business to tell you what the tax law is. It's their business to ask you questions and establish whether or not you did your tax return based on the law. She interviewed you and asked you how many hours. You answered the question, and that was the answer that you gave her. So it's not her fault. It's your fault. And how do you know what your hours were? Have you ever added them up? And he said, no, I've never added them up. So he went home and he sat down and he did a calendar of all of the days that he'd gone out and worked on his boat. And he was fairly much convinced he'd done more than 500 hours, and he wanted to amend his return. I don't know what happened after that point. I never saw him again. But essentially, when IRS has made a ruling like that and closed the book, the only thing you can do is an audit reconsideration request and go in with all of the additional information to try and establish your point. So definitely auditors are aware of these passive activity loss limits, and the 500-hour test is a key important one. But if you don't meet the 500-hour rule, it's possible you're still going to meet some other rule that will still allow you to be considered materially participating. And these tests that I'm reading you here come from publication 925. They're listed on pages 5 and 6. You materially participated in a trade or business activity for a tax year if you satisfy any of the following tests. More than 500 hours of participation. You participated in the activity for more than 500 hours. Your participation was substantially all of the participation. You provided virtually all of the participation in the activity, and under this test, little or none of the participation came from other owners of the activity or from employees of the activity. More than 100 hours and the majority of participation. You participated in the activity for more than 100 hours during the year, and you participated at least as much as any other individual for the year, including individuals who did not own any interest in the activity. Significant participation activity. If you have more than one activity, you will meet this test if you participated in all activities for more than 500 hours during the year, and you participated in each activity for more than 100 hours during the year. A significant participation activity is any trade or business activity in which you participated for more than 100 hours during the year and in which you did not materially participate under any of the material participation tests other than this test. Material participation in the activity for any 5 of the 10 immediately preceding tax years. You materially participated in the activity for any 5 taxable years during any 10 of the immediately preceding, and they don't have to be consecutive. Or if the activity is a personal service activity for any 3 preceding years, regardless of the amount of time. So we're in the tax business, right? So we're in a service-oriented activity. And what this is saying, this particular exception is, maybe we retire and we're letting other people do substantially all of the work in the activity, and we merely retain ownership and continue to receive income from that activity, then we're still considered to be materially participating in the activity, even if we had no other involvement except for earlier involvement in at least 3 earlier years. Number 7, you participated in the activity on a regular, continuous, and substantial basis. You did not materially participate in the activity under this test if you participated for 100 hours or less during the year. Your participation in managing the activity does not count in determining whether you materially participated under this test if any person other than you received compensation for managing the activity, or any individual spent more hours during the year managing the activity than you did, regardless of whether that individual was compensated for management services. Participation, in general, any work you do in connection with an activity in which you own an interest is treated as participation in the activity. And work not usually performed by owners, you do not treat the work you do in connection with an activity as participation in the activity if both of the following are true. The work is not the work that is customarily done by the owner of that type of activity, and one of your main reasons for doing the work is to avoid disallowance of any loss or credit from the activity under the passive activity loss rules. Participation as an investor. You do not treat the work you do in your capacity as an investor in an activity as participation unless you are directly involved in the day-to-day management or operations of the activity. Work you do as an investor includes studying and reviewing financial statements or reports on operations of the activity, preparing or compiling summaries or analyses of the finances or operation of the activity for your own use, and monitoring the finances or operation of the activity in a non-managerial capacity. A final note here, spouse's participation. Your participation in an activity includes your spouse's participation. This applies even if your spouse did not own any interest in the activity and you and your spouse do not file a joint return for the year. So let's just say you own a 7-Eleven franchise. You don't work in it. You have employees that work there. Your spouse has no ownership in that franchise but manages and supervises the work of the employees of that activity. Because your spouse is active in it, material in it, you are considered to be material in it even if you devote zero time and you're just merely the owner. Sale of a passive activity. You may generally deduct any prior year's suspended losses and current year passive activity losses if you dispose of your interest in the activity during the year. This rule applies if you dispose of your entire interest in the activity and you do not make the sale to a related party. And here is an illustration of a sale of an interest in a passive activity. Donald Duck disposed of his entire interest in Daisy LLC in a sale to an unrelated party. Donald is a passive partner in the business and had a $13,000 prior year suspended loss that is carried forward to this year. His current year passive income is $5,000. Donald has no other passive activity income or loss for the year, and since he has disposed of his entire interest in Daisy LLC, he is going to be allowed to claim any outstanding losses after reducing those losses by his current year income. If you take the current year income of $5,000 and subtract that from his carry-forward loss of $13,000, you have a resulting net outstanding loss of $8,000. And he's going to be allowed that loss in full because he has disposed of his interest in the activity, all of his interest. So in the year that he disposes of his interest in the activity, he's going to figure his net loss for the year. He's going to enter that in the passive loss allowed column of Schedule E, page 2. This is a partnership, so we have put a P on line 28B. We figure the loss all the way down to the bottom of the form, and then finally we carry that over to his Form 1040 and allow it in full. Dispositions other than by sale. If you dispose of your property other than by sale, additional rules do apply as follows. Firstly, by inheritance. Suspended losses are reduced by stepped-up basis. Excess losses are claimed on the final return of the decedent. Like-kind exchange. Your suspended losses remain suspended losses on the new property that you acquire. However, suspended losses are deductible to the extent of any taxable boot that you received from the exchange. Installment sales. Suspended losses are deductible each year a gain is realized. Sale to a related party. Your suspended losses remain suspended loss until such time as the related party sells the property to an unrelated property or you have other passive income. Divorce. If you transfer property in a divorce, your suspended passive losses associated with the activity are transferred to your spouse. Your spouse who receives the property will add the suspended losses to his or her basis. And passive activity changes to non-passive activity. If you became active in an activity where you were previously passive, your prior year's suspended losses remain passive losses. Suspended losses may be claimed to the extent of income produced from the activity plus income from all other passive activities. Unallowed passive activity credits. We talked about this a little bit ago. We're going to bring it up again here. Prior year unallowed passive activity credits cannot be claimed when you dispose of your entire interest in a passive activity. However, the amount of unallowed credit can be used to determine your gain or loss upon disposition of the activity. You can elect to increase your basis in a passive activity by the amount of original basis reduction that was attributable to the unallowed credit to the extent that the credit was not allowed because of the passive activity limits. You cannot elect to adjust the basis for a partial disposition of your interest in a passive activity. See the instructions for Form 8582CR, which is credit, for more information. And I have an illustration here of how that would work. Richard Boone disposed of his entire interest in the passive activity Paladin LLC. He has prior year unallowed disability access credit in the amount of $2,000. Richard can elect to increase his basis in Paladin LLC by that $2,000. Activities that are not passive activities. The following activities are not considered to be passive: a trade or business activity in which you materially participate, a working interest in an oil or gas well which you hold directly through an entity that does not limit your liability, the rental of a dwelling unit that you also used for personal purposes during the year or for more than the greater of 14 days of the number of days during the year that the home was rented at fair rental, an activity of trading personal property for the account of those who own interests, and rental real estate activities in which you materially participated as a real estate professional. There's another note here on rental income that is reportable as self-employment. The IRS has basically said that rental income is passive, but there are certain situations where you may be renting the use of property that is deemed to be real estate, but it's not a passive activity. Rather, it is self-employment activity, and this is what that is. If you provided significant services that are primarily for the tenant's convenience, such as regular cleaning, changing of linen, or maid service, you do not report your rental income on Schedule E. Instead, you report your rental income and expenses on Schedule C, profit or loss from business. Rental income from real estate and personal property leased with real estate is not included in earnings subject to self-employment tax unless either of the following rules apply. Number one, you are a real estate professional, or number two, you provided significant services for your tenants. You are a real estate professional if you are engaged in the business of selling real estate to customers for the purpose of making a profit from those sales. Rent you receive from real estate held for sale to customers is subject to self-employment tax. However, rent you receive from real estate held for speculation or investment is not subject to self-employment tax. And trailer park owner. Rental income from a trailer park is subject to self-employment tax if you are a self-employed trailer park owner who provides trailer lots and facilities and substantial services for the convenience of your tenant. You generally are considered to provide substantial services for your tenants if they are primarily for the tenant's convenience and not normally provided to maintain the lots in a condition for occupancy. Services are substantial if the compensation for the services makes up a material part of the tenant's rental payments. Examples of services that are not normally provided for a tenant's convenience include supervising and maintaining a recreation hall provided by the park, distribution of a monthly newsletter to tenants, operation of a laundry facility, and helping tenants buy or sell their trailers. Examples of services that are normally provided to maintain the lots in a condition for tenant occupancy include city sewage, electrical connections, and roadways. Also hotels, boarding houses, and apartments. Rental income you receive for the use or occupancy of hotels, boarding houses, or apartments is subject to self-employment tax if you've provided services for the occupants. Generally, you are considered to provide services for the occupants if the services are primarily for their convenience and not services normally provided with the rental of rooms for occupancy only. An example of a service that is not normally provided for the convenience of occupants is maid service. And examples of services which are normally provided to tenants include providing heat and light, cleaning stairways and lobbies, and collecting trash. And the final topic of the day, kind of a throw-in at the end in the last 5 minutes of our class, is farm rental income. If you were a landowner or sublessor and did not materially participate in the operation of the farm, and rents you received were based on produce, grains, or crops or livestock that were produced by the tenant, report your farm rental income on Form 4835 instead of on Schedule E. Under both the cash and accrual methods of reporting, you must report livestock or crop share rentals received in the year you convert them into money or its equivalent. Determining the character of farm rental income. And this information comes from IRS Publication 225, page 74, which is the Farmer's Tax Guide. As a general rule, income and deductions from rentals and from personal property leased with real estate are not included in determining self-employment earnings. However, income and deduction from farm rentals, including government commodity program payments received by a landlord who rents land, are included if the rental arrangement provides that the landowner will, and does, materially participate in the production or management of the production of the farm products on the land. Crop shares. Rent paid in the form of crop shares is included in self-employment earnings for the year you sell, exchange, give away, or use the crop shares if you meet one of the 4 material participation tests that are described next at the time that the crop shares are produced. Feeding such crop shares to livestock is considered using them. Your gross income from figuring your self-employment earnings includes the fair market value of crop shares when they are used for feed. Material participation for landlords. So essentially, Form 4835 is a very specific form. You use the form if you do not materially participate in any way in the operation of the farm, but your income is based on products produced by the farm. If you are in fact paid cash for the land, then you would use Schedule E. And if you do materially participate in the operation of the farm, with a tenant farmer is paying you rent for, then you would report that income on Schedule F for farming income. But if you do not materially participate and you do not receive cash, and instead you receive the share of the profits from the farm, then that is considered to be farming income that is reportable on this 4835 form. So how do you determine whether you are materially participating as a landlord in the operation of the farm? The IRS says if you meet these tests, then you are materially participating, and you would use Schedule F instead of the form. You materially participate if you have an arrangement with your tenant for your participation and you meet one of the following tests. Number one, you do any three of the following. Pay using cash or credit at least half the direct cost of producing the crop or livestock. Furnish at least half of the tools, equipment, and livestock used in the production activities. Advise or consult with your tenant, or inspect the production activities periodically. Or two, you regularly and frequently make or take an important part in making management's decisions substantially contributing to or affecting the success of the enterprise. You work 100 hours or more spread over a period of 5 weeks or more in activities connected with agricultural production. Or you do things that, considered in their totality, show that you are materially participating and significantly involved in the production of the farm commodities. These tests may be used as general guides for determining whether you are a material participant. And the IRS gives an example here. Drew Houston agrees to produce a crop on J. Clark's cotton farm, with each receiving half the proceeds. Clark advises Houston when to plant, spray, and pick the cotton. During the growing season, Clark inspects the crop every few days to determine whether Houston is properly taking care of the crop. Houston furnishes all labor necessary to grow and harvest the crop. The management decisions made by Clark in connection with the care of the cotton crop and his regular inspection of the crop establish that he participates to a material degree in the cotton production operations, and therefore he would file Schedule F and report the farm income as self-employment income. So when don't you use Form 4835? Do not use Form 4835 if you were a tenant. Instead, you use Schedule F. Or if you are a landowner who materially participates, then you use Schedule F. If you are a landowner who received cash, then you would file Schedule E. If you are an estate or trust with rental income and expenses from crop and livestock shares, report that on Schedule E, Form 1040. And if you are a partnership or S corporation with rental income and expenses from crop and livestock shares, you would report that on 8825. And Form 4835 is used to report the following kinds of rental income from farming and production activities where you do not materially participate in the farming activity, including income you received from livestock, produce, grains, and other crops based on production under both the cash and accrual methods of accounting. And they include total distributions from cooperatives as shown on Form 1099 PATR, agricultural program payments you received, CC loans forfeited, and crop insurance proceeds. And this is the form itself. You can see that it provides space to enter the various types of commodities that you would have received a profit share from, and then space to enter all of the expenses that are provided space for. So that concludes our presentation of rental property and passive activity loss limitations. As you recall, I also gave you a classwork assignment. So here we have Rudolph. Again, I provided you all of the information relating to his ownership of a rental property and the fact that this is a property that he lived in for 1 month out of 12 months of the year. So he's basically moved out and converted it to rental use. And one of the things to bear in mind is that in this kind of situation, there is 0% owner use during the period of rental because it was only available for rent for 11 months of the year, and there was 0 occupation during that 11 months of the year by Rudolph. So he's going to be allowed 100% of the expenses attributable to that rental property from the time he moved out. And by now you should have had a chance to read through all of the various types of expenses that he had. The other thing that I did want to point out to you is his other income, $50,000 on a W-2, and the fact that he has losses. He has a loss from Reindeer LLC in the amount of $10,000. This is a partnership 1065K1. And he also has a loss coming through to him from Toymakers Inc. of $5,000. Now we need to go and look at my comments on those two activities, because how and whether he's allowed to claim his losses is dependent on the at-risk rules and the passive activity loss rules. Rudolph received a W-2 and 2 Schedule K-1s. Rudolph is a passive partner in Reindeer LLC. His capital account is correctly reflected on the K-1, so we'll take a look at that. Rudolph is an active partner in Toymakers Inc. His capital account at the beginning of the year was $0, and during the year he contributed $2,000 to the business. So he's added $2,000 to the business for Toymakers Inc. Toymakers Inc. has a $5,000 loss. He started the year with 0 basis. He's put $2,000 in. So mentally that should be saying to you, okay, well, if I put $2,000 in, then maybe I'm allowed a $2,000 loss, but I can't claim more than I'm at risk for. And then we've got the Reindeer LLC. It's a $10,000 loss. And what is his capital account showing? His capital account is showing $20,000, $10,000 of loss for the year, and a year-end basis of $10,000. The problem with Reindeer LLC is he's passive. So he's going to be affected by the passive activity loss limits on Reindeer LLC, and he's going to be affected by the at-risk limits on Toymakers Inc. So let's go take a look at his finished return. So earlier in the day, I asked you guys to work on coming up with the net income from the rental activity. And when I asked you to type in what you thought his loss was or his net income was, I said that a couple of you had the right answers. So let's go take a look at the finished Schedule E so you can see the numbers that we put on, and you can compare that to the numbers that you entered. So here is Rudolph's Schedule E, and the first thing you had to do is correctly identify how much rental income Rudolph had brought in. And we've indicated that he brought in $13,200 of rent income. And then we have all of the following expenses that we figured for him. So there were at least 2 people who were popping up the correct answer of $118 net income from Rudolph's rental property. And I'm not going to sit here and show you exactly how we figured every line entry on here. At the end of class, if you wish to go print this answer key, you can do so. I just wanted to get to this point where you can see that we did arrive at a net income of $118. But we also have some other things to consider. Firstly, we have Reindeer LLC. Reindeer LLC is an activity in which he is at risk, but he is passive. So he has a loss, but he can only claim the loss on that passive activity to the extent that he has other passive activity income. And he has passive activity income from the rental property in the amount of $118. So that is the amount of passive activity loss he's going to be allowed to claim. With regards to Toymakers Inc., he is active in that activity, but he's not at risk for all of the loss. The loss was $5,000, but he's only at risk for $2,000. So we're going to enter a non-passive loss in column H of $2,000. So we add up these amounts, we get $2,118 as the net loss from these activities, but he's got $118 of income from the rental activities. So his net passive activity loss is 0, and his net non-passive loss is $2,000. So when we move over to the 1040, we end up with $2,000 as the number entered on line 17. Now I did want to show you 2 other forms that had to be completed. One of them is Form 6198 for at-risk limitations. We started off with $5,000 as the ordinary income or loss from Toymakers Inc. We started the year with 0 basis. Rudolph threw in $2,000, so ultimately he is allowed a $2,000 loss. And on the 8582, we have $118 of profit from the rental activity. We have a $10,000 loss from the LLC, but he's not going to be allowed to claim more than $118 of loss, and so we ultimately have a $9,882 carry forward to 2013. So that concludes the review of Rudolph Deer's answer key. I do see some questions here. For a real estate professional, is the test for material participation only 500-hour test or substantially all the work test? Well, for a real estate professional, there was 2 tests. One of the tests was 750 hours plus that has to be the majority of your participation in any activity. So it isn't a 500-hour test for the real estate professional. It is a 750-hour test plus you have to show that that was your major occupation, that you have no other occupation that's occupying more time. And then the next question is, in the case of the yacht rental you described earlier, you said it was a yacht rental, which wouldn't be passive because it was rental regardless of the level of participation. Well, when you rent personal property, and a boat is considered to be personal property, that is reportable on Schedule C. The question is, was he allowed to claim a loss against other income from that Schedule C because it was deemed to be a passive activity? Wouldn't the yacht rental be passive? Isn't all rental deemed passive? No, the rental of personal property is not deemed to be passive. If you're operating the rental of the yacht as a business activity, it would be non-passive. IRS goes out of its way to say the rental of personal property is not normally considered to be non-passive. But you still have to pass all of the material participation tests for it to be considered non-passive. And so in his case, he failed because he told the auditor only 300 hours. You can think of like a tool rental place. Clearly, people are walking in, or a video store. Now, that would be an excellent example. Video rentals are kind of a dying business, but video rentals, you go in there and you're renting video cassettes. And those are clearly retail-type establishments that are going to be reporting their income as self-employment income or some other kind of business activity income. They would not be passive because they're still in the rental business. If someone rents a premise, but at the same time a person renting someone else a part of the same place, what form should they do? So you've got a business and you're renting it and then you sublease. Well, if you're subletting property that you are already leasing, you would report that on a Schedule E, unless you can show maybe you're renting it to another tax preparer and they're paying you somehow in that capacity. Like I've seen beauty salons where they're renting out chairs. You've got the person who owns the salon and they have income from their own salon activity, and then they have other hairdressers in there who are paying them rent for their stools and so forth. I would say in that situation it all belongs on Schedule C. But in your case, you've collected the rent in, and then if you're not involved in any business capacity in terms of the sub-rental, then I would put that on a Schedule E. I haven't had to think about that. I'm guessing. Your questions with regards to the 500-hour rule, if you meet the 500-hour rule, you don't need to meet any of the other rules. If you do not meet the 500-hour rule, then you may still be considered to be materially participating if you meet one of the other rules. But to be considered a real estate professional, you don't even look at that. You have to look at the rules for real estate professionals, which are 750 hours plus that's the majority of your work. So the 500-hour rule relates to just businesses in general of any type. And if you're trying to meet the rules for being deemed to be a real estate professional so that you may claim real estate rental losses in full and not have them treated as passive activity losses, you have to have that 750 hours. So they're really two separate things. The answer key for today's classwork assignment is inside the LMS. It's the same place that you went to print the manual. If you just scroll down that page on the materials page of the Learning Management System, you will see that there is the answer key there, and yes, you can print it. So this is what I've been saying. Page 51, who qualifies as a real estate professional? Qualifying as a real estate professional is different than qualifying under material participation rules for whether you have a passive or non-passive activity. And perhaps the confusion is over whether or not rental property is passive or non-passive. The IRS says rental is always passive, regardless of how many hours you put into it, unless you're a real estate professional. And then to be a real estate professional, you have to pass the 750-hour test. Let's pull away from rental property and look at any other business activity you might be involved in. Say, for example, a tax service or a CPA firm. Under those rules, you have to participate 500 hours during the year or meet one of the other rules to be considered materially participating. Okay, the difference between the yacht rental and renting real estate is that the yacht is not real estate. Rental of real estate is always deemed to be passive, with the exception of real estate professionals. But rental of personal property is not considered to be something that's reported on Schedule E. It's something that's reported on Schedule C. So then when you go to Schedule C and you have a loss, is the loss allowed? And that's where you apply the 500-hour rule. So the yacht never went to the Schedule E. It's not even an issue to do with Schedule E. It has to do with Schedule C and whether or not losses could be claimed on that. Let me go there for you. So I'm in the same page as you, Keith, on page 3, and you can look under exceptions. It says your activity is not a rental activity if any of the following apply. The average period of customer use of the property is 7 days or less. So you could be renting personal property that could be deemed to be a passive activity, but in the case of a yacht or in the case of a videotape, you're looking at also the amount of time that the property is rented for. And if the average is 7 days or less, then it's not considered to be passive. So there's a whole list of exceptions in there on page 3. So you could say we both win this argument. You're probably reading quite a bit that is very relevant there. And, you know, each and every situation, if you've got a situation where you're questioning, hey, have I got a passive activity or have I got a non-passive activity, I would be burrowing into the facts and seeing whether or not it does or does not meet the exceptions offered. So it's good that you have it in your head that you should always be asking the question, because it means that you're aware there could be an exception. Breen, B-R-E-E-N, Breen.